Learning to trade has honestly been the best decision I've ever made in my whole life. I've made so much money and I've done it all from home. I haven't had to speak to any customers, get on any sales calls. And if you're an introvert, trading by far is the best business model. You can make all the money in the world from your bedroom, right? Like, fuck dropshipping, fuck selling a t-shirt for $1. Trading is what you want to be doing. And in this video, I'm going to give you a completely full, free, no BS guide on how to become a profitable trader, assuming you've got no experience whatsoever. And I'm going to take you to a complete pro like I am. So make sure you like and subscribe because this video is going to be absolutely amazing. Okay, so what actually is trading, right? Trading is literally as simple as this. It's buying and selling for a profit, right? Let me say that again. Trading is literally buying and selling for a profit. That's all it is at its most basic form. And there's so much BS in this industry designed to essentially confuse you. All you need to think about is buying and selling for a profit, right? That's all we do as traders. And this is what we do in any market. Now, a market is just something you can trade, but right here is the S&P 500. Now, most of you probably know this, even if you're not traders. This is the top 500 companies in the US, right? And this exact thing you can trade on Tesla. So if we just type in Tesla here, right? We get Tesla up. Tesla, a stock in the US. You can do the exact same thing on Tesla, on Bitcoin, right? On Bitcoin, any financial market. Now, a financial market is just something that essentially has these candlesticks. Anything that has candlesticks, the only reason that traders participate is to buy and sell for a profit, right? Traders are not investors. They don't buy, let's say, buy and then hold for like a year or two. That's not what traders do. That's investors, right? Traders are here. We're holding for, most traders, most day traders, and we'll get on to day trading later on. Most day traders are holding for a few minutes to a few hours. Most swing traders, like me, are holding for at most a week or two. At most a week or two. So if you're a trader, we're buying and selling, very short-term movements. We're here just to buy and sell, make money, and get out of the market. We're not here to hold on for 20 years. We don't care about that. We're here just to make money quickly and to move on to the next asset. Okay, so now that you know trading is about buying and selling, the next thing we need to understand is what is a candlestick chart. Now, a candlestick chart is essentially this, right? Because any market that you trade, it's going to be shown with these candlesticks here, right? Like this. Now, if this was the first time that you've seen candlesticks, this probably looks like absolute gibberish to you, but I promise you, it's really not that hard. It's just, it takes maybe like a few days to get used to it. But what a candlestick chart actually is it's just a way of representing information, right? So let me just go back on this. You've probably seen, let's say if you are like an investor, like the S&P 500 on a line graph, right? Just something like this, right? Like a line graph. Yeah, okay, that looks good. But as a trader, there's virtually no information here, right? There's no information here. Now, as traders, we need information, especially because we're short-term traders. We need a lot of information so we can make decisions very quickly, right? This isn't like some line graph because the line graph is very limited. So we need these candlestick charts because it tells us a lot of information. Now, what it actually tells us is there's two types of candlestick charts, so bullish and bearish. Now, bullish just means buy or up close candle, means up, means price has gone up. And bearish means short, right? It means price went down. It means people sold, right? Green means up, red means down. So we go in here. This candle here is a green candle. That means it was bullish. That means that price went up, right? Price started off here, it went all the way up here, and it closed down here, right? That's what a bullish means. That's what long means. They mean the exact same thing, right? Bullish / long, bearish / short. They're the exact same thing. Now, this candlestick here is a short candle, right? That means that price started off here and then it stalled. It went down all the way down here, right? That's what bullish and bearish actually means. So for the candlestick chart, for the bullish example, this low of the body when it's bullish, right? This is the open. What this means is for every time interval, right? Just stay with me here because this might go over your head at first, but just really do pay attention here. What this means is for every time interval, this is where price opened. Now, by time interval, we can choose what time frame to trade. But right here, we're on the 1 minute chart, which means every single candlestick here represents 1 minute, right? So this is at 8:40 a.m., right? This candle here, 8:41 a.m. This candlestick here, 8:42 a.m. and so on and so forth, right? Now you can change this time frame to the 5 minute, 15 minute, 4 hour chart, the daily chart, whatever. And then let's say it's a daily chart. Each candlestick will represent 1 day, right? 1 unit of time. That's all it means. But for that example, we're on the 1 minute chart. So what this means is that price will open, right? It will start off, price will start off on the time interval at some sort of price here, right? This is the low that price will do. So let's say price opened up here, it moves down here, it goes all the way up to this high, all the way up to this high, and then closes there within the minute. Right? Within 1 minute, this is what price did. It opened at some level, it went down, it went all the way up here, and then it closed within a minute. And now close means where price was at the end of that minute. right? So at the end of the minute, where was price actually? And then the open is where was price at the start of the minute, right? So the start of the minute, it was here. At the end of the minute, it was here. And then the wicks here, which is just the bit that points out on both sides, that's the absolute highest price that price was within the first minute, right? Within the minute of that candlestick, if you're on the 1 minute chart. And this was the absolute low that price went to if you're on the 1 minute chart, right? And the exact same thing here, right? When you're bearish. The only thing is, when you're bearish or when you're short or when you're looking to sell, you just flip on your head, right? So for these candlesticks here, which are red, right, you flip it on its head. So let's say, because we're on the 1 minute chart, price opened, right? It opens here, it goes all the way up here, right? Within 1 minute or within 1 day or whatever the time frame is. Price starts off here at that minute, it goes all the way up to this high, it drops all the way down here, all the way down to this low, and it moves up, it retraces slightly, and then it closes here, right? That's what a candlestick does. It shows us where price started off in that time interval, where it ended, and the highest point that price was, and the lowest point that price was during that time interval. Now, as traders, that's very important, and especially as we get further on into the course, that's quite important to understand, right? And if you compare that to a line graph, which has virtually no information, and candlesticks by far night and day are way more important for trading. But as always, with all things, it takes a few days just to get used to candlesticks. Okay, so just to recap, the green candles are always bullish, which means price is going up. The red candles are bearish, which means price is going down, right? And then for the bullish candle, what this candlestick represents is that price opens here, it went all the way down here, it went all the way up this high, and then it closed at this point here, right? For either some unit of time, whether that's the 1 minute chart, like it is here, or it can be 2 minute, 3 minute, 5 minute, and 5 minute here, the 1 hour chart, the daily chart, the weekly chart, whatever it is, this represents 1 unit of time, right? And time we can just mess around on this platform. And this platform is tradingview.com. This is every single trader is using tradingview.com. Every trader uses it completely for free. And go get this up. Go look at your favorite instruments. Go type in Tesla or Bitcoin, or the S&P, which is ES. Type in anything that you want, and yeah, just go look at these candlesticks. Go look at them, and make sure you understand them. Green means up, means that price has gone up, or bullish, as we call it as traders. And then red means that price has gone down, or it's short. Right, that's what we call it as traders. Okay, so what can we trade as traders? Now, this is so important. There's literally an infinite number of markets. There's so many. There's thousands and thousands of markets now. As a trader, you really want to specialize in maybe 1 or 2 types of markets, but in trading, there's really 5 major markets that you can trade, and then you can break them up into smaller sections. And those are stocks, cryptocurrency, Forex, indices, and commodities. Right, those are like the 5 major types of markets. Now, indices, I'm going to lump together with futures. Right, now, futures is just a type of contract. You don't need to worry about that, and that's not important. What's really important is understanding price action. Now, price action is just these candlesticks and what price is going to do. But this is so important. Every single financial market, and by financial market, I mean any of these markets here, they all move in the exact same way. So the exact same principle I'm going to teach you throughout this course, especially liquidity, it works on all of these markets, right? So all of these markets have the exact same thing. And I'm just going to give you guys some entry patterns now, right? Because right away my eyes see this, and this is something we're going to talk about later on in the course. But this little gap here between this candlestick here and this candlestick here, or fair value gap, right? That right there is a fair value gap. And you'll see this so many times in price action. It's insane. You'll see it over and over and over again. Now, don't worry about this. We're going to have a full video, or at least a full section in the course later on fair value gaps. But what you would do as a trader, if you were trading stocks, you'd enter on this fair value gap, you'd put your stop loss. Now, stop loss is really important. Stop loss is what prevents traders from being gamblers, right? So a stop loss is, and let me get this up. Now, this is the path. Let's suppose at this level here, you enter the trade. Now, enter the trade, I mean, as soon as it hits this level, you start to sell, right? You're bearish on Tesla, you think it's going to keep going down. That's what you do, right? So let's say, so price has come down, and you've now entered the trade. Now, enter the trade means you've literally just got into the position, so you're shorting, right? If you don't have a stop loss, price could go all the way up against you, and you could lose thousands of dollars. We don't want that, right? If we lose as a trader, we want to keep our losses small and our winners big, right? So a stop loss, what it does is as soon as price hits this level, our position automatically closes. It gets us out of the position. We don't sit there and babysit it. As soon as it hits that level, we're out of the position. And having a stop loss is what prevents traders from being gamblers, right? The 90% of traders that lose aren't using stop losses, and they have no idea what they're doing, right? They're literally gambling. But professional traders always have a stop loss, and I'm going to teach you to always have a stop loss, right? So That's what a stop loss is. Now, there's an opposite of a stop loss, which is a take profit. Take profit is as simple as it sounds. It literally is. Where are you going to get out of your position? Because anytime you enter a trade, you need to know two things. Where am I going to get out? Right, so get out could mean stop loss. And then where am I going to get in? So get in is just your entry now. Don't worry about the entries, we're going to talk about it later on, but let's just suppose you enter this level. As soon as you enter the trade, or even before you enter the trade, you need to know, okay, where am I going to get out, right? If things go bad, if things go against me, I'm going to get out at this level here. As soon as price hits a level, my stop loss will get triggered and it's going to pull me out of the position. Now, you also need to know, okay, what happens if the trade does go in my position, right? What if trade does go in my position? So something like this, prices come down and then how do you win? Now, we say this a lot as traders. How do you win? All that means is that you're now in the position. And now in your position, you're now in your trade. Let's say you're in your position like that, and then price starts to move down, right? Right here is your take profit. The moment price hits this green line, right? So right here, as soon as it hits this green line, bam, just like that, you're out of your position. Your position is closed. You're out of the position, you've got your money. And as traders, and we're going to talk about this later on in the course, we have something called a risk to reward ratio. Now, this is so important. What that means is for every $1 we're risking, we're aiming to make $3. Or realistically traded, for every $1,000 that you're risking, right? And by that, I mean your stop loss. So if your stop loss gets hit, let's say it's $1,000, okay, fine, not bad. And you'll see your trading, the numbers get bigger and bigger and bigger, the better and better you get, right? So let's say your stop loss is $1,000, which means if price does this, if price comes all the way up, it's your stop loss, you will lose $1,000, okay? Right, that might sound, and to most people outside of trading, that sounds absolutely insane. But if you're a trader, that's just a normal day in business. But on the flip side, if you win, so let's say you're in the trade like this, right, and price comes down and hits your take profit, because right now it's a free risk to reward ratio. Look at this here, right? This free here means for every stop, so our stop loss, our take profit, the take profit is 3 times our stop loss. So if we're risking $1,000 on a trade, that means our take profit, the moment price comes down here, it goes all the way around here, that means we've now made $3,000. But we're risking $1,000 to make $3,000. Right, I hope that makes sense. Right, that's what stop loss does, is there to protect us and to limit how much we risk, right? Because let's say you've got a $10,000 trading account, right? If you had no stop loss, let's say you had no stop loss and right here's $1,000, right? What are you going to do if price comes all the way up like that, right? Comes all the way up like that. You could lose your entire account and more if you don't have a stop loss. But we always have a stop loss and we always have a take profit. We don't just buy and hold forever, right? That's what gamblers do, when they buy like meme stocks or even what's it called, some of these random cryptocurrencies, hoping that it goes to the moon. We don't do that as traders. We always have a fixed risk to reward, a fixed stop loss, and a fixed take profit. But for stocks, right? So let me just clean these charts up. For stocks, what I would say as a beginner, the two easiest things that you can trade is probably Forex, like this, and indices. But we'll get onto this later on. With stocks, you're probably going to need to use something called options. Now, I'm not going to talk about options in this course because options are very, very advanced. Because not only do you have to do what I just said with trading, right, where you get into the position and get out of the position, you also have to factor in time. So options trading is very, very advanced. And that's how most traders trade stocks. They use options. They don't day trade stocks because of something called leverage, which is essentially most traders don't have much money, especially if you're starting out. You don't have much money. Options give you massive leverage. So what that means is you can put a tiny amount of money in and make a huge amount of profit, but you can also have a huge amount of losses, right? It works both ways. So yeah, that's how stocks are. All of these markets move in the exact same way, and you'll see it, right? So we'll get Bitcoin up next. Now, Bitcoin, like all markets, moves the exact same. Now, it's slightly different to Forex. Forex is just for any exchange rate, right? So you've got the euro against the dollar. You can have the pound against the dollar. You can have the euro against the pound. So the pound obviously being the UK's currency. That's all Forex is. Cryptocurrency is obviously trading crypto. And the thing I would say, like from years of experience, is that crypto is obviously a lot more aggressive. a lot more aggressive than Forex, right? So it's essentially like Forex on steroids, if that makes sense. So what you can expect is, let's say Forex is bullish. You can expect little ranges like that, right? Little retracements like that. Nice and smooth. Whereas crypto, what you can expect, if it's bullish, is like a massive move up, massive moves up, like massive, huge ranges. And now what that means is you can make a lot of money, but you can also lose a lot of money just as easily, right? So, don't be tempted into huge ranges. Let me go trade that, because, yeah, it can work against you as well. But as traders, we do need good movement. And sometimes Forex can be so shit, it's annoying. Sometimes Forex can do this for months and just messing around doing nothing, whereas crypto is almost always moving. At least it seems that way. But anyway, here's Bitcoin. the exact same candlestick, the exact same logic, and I'm gonna give you another entry pattern just because I want you guys to get familiar and train your brains seeing entry patterns. Because the only way you will learn trading is by repetition, repetition, repetition. It's almost, I mean, I've got a master degree, right? But it's almost similar to my master degree, where it's over and over again. You know, like calculus or anything, right? You remember from maths how you practice. They give you a huge worksheet and you just grind through it for ages and ages. That's how you learn. It's the exact same thing with trading, right? Or even programming, right? Remember when you started off programming, you had no idea what an if statement is, right? You know what I mean? But over time, over consistently programming, you get better and better and better. All right? Same thing with maths, same thing with trading, right? Same thing with the gym. It's just the exact same thing, repetition, repetition. So I want you guys to train your eyes to start seeing this out. Now, don't worry about the logic because we're talking about all about that in future videos. But there's something called an optimal trade entry. Now, all an optimal trade entry is a retracement. And you must have heard, before I show you this, you must have heard this so many times. Buy the dip, right? Everyone's heard this. Buy the dip, sell the rally. What that really means, and as traders, this is what we always want to do. If we're bullish, and we'll talk about this in future videos, if we're bullish, which means if we think price is going to go up, right, what we want to see is we want to see price go up, and we want to enter on some sort of retracement. Now, retracement just means price slightly retraces, right, in the opposite direction. We would like to enter somewhere around here, right? Buy the dip, and then ride price low, right? That's what we want to do if we're bullish and we think price is going to go up. Similarly, if we think price is bearish and that's going to go down, we want to see price move down, slightly retrace up, and then we want to sell when price is quite overbought and then ride price down, right? That's what we want to do when we're bearish and we think price is going to go down, right? That's all trading really is. Literally, trading is that simple. That's all we've got to do is just determine, do we think price is going to go up or down, and then enter on some sort of pattern like that, right? And I don't know about you, but Bitcoin's bullish, and this pattern here, price goes up, comes back down, and we continue price up. Very similar, and don't worry if you can't see this, because it's going to take time and repetition. Very similar to this. Price has gone up, it's come down, then it goes back up, right? Now, I know this is a bit like slow, but this is because we're on the 1 minute chart, right? But this is what price is doing, and this is what realistically trading's like, right? Not every time you're going to get this sort of entry pattern, but something that you can do as traders is, this is exactly my entry pattern. It might sound crazy that after years of trading, I literally use the most simple, basic thing ever, because let me tell you something. The more and more experience you get with trading, the less and less things you use, because you see these things, you must have seen online where these guys have, you know, like a million things on their charts, trying to look smart, trying to sell you some bullshit that doesn't work. And simplicity is key, right? The only thing you need to become a profitable trader is something called liquidity, which we'll talk about in future videos. But right here is my entry. Now, the Fibonacci, this Fibonacci here, there's no magic to it. All it does is it just allows me to essentially say buy the dip, right? Because anything below, if you think about it, anything below the 50% level, right, between this low and this high, is essentially cheap, right? Anything below it is essentially at a discount, right? So yeah, and I just always enter this light blue line every single time. There's no magic in that line. I just light entering. And what I do, as always, like I said on the Tesla example, is we put our stop loss at the low. Again, that means if price hits this level here, as soon as it hits this level, I'm out of the position. Get me out of the position. I don't want to keep holding. I don't want to see price come all the way down here. Get me out of the position. And then my take profit is a free risk to reward ratio. So I always, and this is what I do. So, you'll learn, you know, as you get more and more advanced in trading, there's something called prop firms, which is most traders, especially nowadays, you don't trade your own money, because unless you've got like tens of thousands of dollars, trading isn't worth it. But what you do is you trade a prop firm, which is you trade like it's essentially a firm that will give you money to manage, right? And then you trade their capital. So I trade at 100K account, and it costs only like $100, right, or a few $100 to actually get access to that. And so what I would do is I'd risk 1K, so my stop loss. If my stop loss got hit, it'd be $1,000, and then my take profit, because it's 3 times my stop loss, would be 3K. So right here, this is exactly what I do every single day. If price came here, I'd lose $1,000, and if it hits this, I'd make $3,000. Now I don't hold for the moon, and I don't, price is gonna reverse when it goes against me. Same thing, day in, day out, right? So that's how you trade cryptocurrency. All these markets move the exact same way. I just want to keep training your mind and training your brain, essentially, and your eyes to keep seeing these sales. So that's how Bitcoin is. It's essentially a more volatile version of Forex. Now, if we get on Forex, because the thing is with Forex, because it's a professional market. Now, by professional market, I mean the euro against the dollar. That's a major market that everybody's watching. Everybody needs that. So many businesses need the euro dollar, right? It needs to be a stable currency, because if it's not, people are going to lose faith. Same thing with the S&P 500, right? The S&P 500 is like the bellwether for measuring the US economy. Right? These are real markets, and by real markets, I mean, you'll see, especially with things like Tesla, where it can, like go up like 50% or whatever in like a week. You're never going to see that with the S&P or Euro. You're never ever going to see that. You can see it with Bitcoin. You can even see it with crude oil, but you're never going to see it with these massive major markets. You're never going to see that because the government will get involved, right? So anyway, that's for another topic and for another discussion. But Forex, it's nice, it's predictable, it's slow. So if you like fast trading, you probably want cryptocurrency or stock trading or even futures. But the Forex is slow, and for me, slow trading is easy trading. Now, I'm going to mention something very briefly here because this isn't I don't want to get too much into detail because we're going to go off topic. But there's essentially two ways you can trade the market. Right? There's day trading. Everyone knows. Day trading is you buy and sell on the same day. So run the 1 minute chart here. So right here, you would enter at 2:15 a.m. New York time. Right now, don't worry about this because this is around 7 a.m. in the UK. You would enter at 2 a.m., 2:15 a.m. and then buy 2:53, right? So within 45 minutes, you would have made 3K. Right? Not bad. Not bad. But this is day trading. What that means is that we're done within the same day. We're buy and sell within the same day. Now, I've started off as a day trader for years, but as I get more and more busier, and you'll get this as you get more and more confident and experienced at trading, it's like you get bored of it. You get bored of it and you want to move on to other things in life, right? So what I do now is I do the exact same thing, literally the exact same thing I told you here, but change the time frame from 1 minute to 4-hour chart, right? 4-hour chart. So I do the exact same thing, but I do it on a 4-hour chart. Now, you'll know people say price is fractal. What that means is that these concepts, what I'm teaching you in this course, it works on every single time frame, all the way up onto the month chart, down to the minute chart, even the 1 second chart. These concepts work on all time frames. So the exact same thing we're doing here is what I do here. Because for me, and I'm not going to tell you in this video how I determine this, because this is for at least not this part of the course, because it's for a future part of the course. For me, the euro dollar is bearish. All right, I think the euro dollar is going to go down. Right, so I want to see something like this. Right, I want to see price come down, and I want to sell the rally. I want to sell the rally as price comes up, and then continue price down. Right now, I don't know about you, but can you guys see something similar here? Where price comes down, comes up, we're going to sell the rally. All right, we want to sell the rally. Now, all this is in live price action right now, and this is a real trade that I'm in. So what I do, as always, you guys know my entry time is I get the Fibonacci from the high, and people keep asking me this, and those who watch a few of my trading courses, you want to put the Fibonacci on the most obvious swing high, right? The most obvious high, which is this, or the most obvious low, which is this, right? The most obvious one. Now, you can put it here, and in this case, it'd be a losing trade, but for me, this is the most obvious one because it's almost like a V shape. Let me just mark this out, right? It's almost like, see that, right? It's almost like a V shape, like the top of a house, if that makes sense. And then this is like an obvious low, right? Whereas this is like in between, if that makes sense. This right here is the obvious high, not this one, right? This is our obvious high. This is the obvious high here. So, yeah, the thing is, you can never get perfect with which high you put it on, but for me, this is what I like. And if you know more about trading, right, so if you watch my videos, you'll notice that this is an order block and that price is reflected it. But if you don't know that, don't worry. But this right here is the 4-hour chart. Now, each candlestick is literally 4 hours. So what that means is that these trades are going to take a few days to about a week or two, right? At most 2 weeks. So what I would do for my entry, I enter on here. I put my entry here, stop loss here. Remember the exact same thing, 1K risk. So if price comes up here and I lose $1,000, and then I aim for a free risk reward ratio. Now, this is something called swing trading. Let me get the free risk reward ratio. This is something called swing trading. Now, this is really, really important. Right? The difference between day trading and swing trading is absolutely crucial. Day trading, like we said, you're holding on for a few minutes, or well, a few hours really. At most a few hours. You're closing your position, you're buying and selling the exact same day. Like the exact same day, you're buying and selling, and then you're getting out your position. You're not holding overnight. Whereas for swing trading, you're holding for a few days to a few weeks. Now, I'm going to say something which might seem controversial to a few people, but if you're new to trading, swing trading by far is the easiest way of trading. Let me tell you that. Swing trading by far is the easiest way of trading. I wish I could go back in a time machine and tell younger me, fuck day trading, bro, because this is so much harder than swing trading. Everything's so easy, predictable, slow. It's just so much easier. And honestly, if you really want to be a trader, if you're watching like 20 minutes into the video or however long this course is, if you're still watching and you're in the top 10%, because most people can't even watch this far, let alone like 5 minutes into the video. So if you're watching this far, you probably have what it takes to become a profitable trader. Let me tell you some big brother advice. please just stick to the higher time frames, because trading the higher time frames are so much easier. And assuming you got into trading just to quit your job, be financially free, be financially independent, those higher time frames and swing trading will make it possible so much quicker. So much quicker. Don't fall into illusion of day trading where, oh, I made 3K in an hour. Okay, well, you can lose 1K within 2 minutes, right? Exact same thing. Don't fall for that trap. Swing trading is so much easier, so much cleaner, and so much better, in my opinion, right? And this took me years of trading to figure this out. So indices, which are literally a group of stock markets, are very professionally traded. Now, by that, I mean, just like the euro dollar and just like, let's say, GBP USD, these markets are so important. Like the S&P 500, I think this is literally the most traded market in the world. Like, it's so important. It's the US stock market. US obviously being the most powerful country and the most richest country. And everybody's looking at this. Not just Americans, but everyone around the world looking at this. They're investing in this. And, billions and billions of dollars are moving into this market and out of the market. It can't be doing crazy stuff, right? It can't be doing crazy stuff. Like crypto moving up like 10% in a day. It cannot be doing crazy stuff like this, but absolutely insane movements. It has to be small ranges, professionally delivered. Although saying that, you do get a lot of you do get the occasional BS that comes into these markets. But indices very nice, and futures, I don't want to get too much into this, but futures are traded mainly by American traders because it's just for tax regulation stuff. So if you're in the US, you'd probably want to look at either trading futures, so like the futures indices, or looking at options, right? I think almost anyone outside the US, and they don't really trade stocks because options are very hard. At least in the UK, it's really hard to even get any decent option brokers. But yeah, that's how indices work. All these markets, like I keep saying, all these markets move in the exact same way, the exact same logic. It applies to all these markets, right? So we've covered stocks, crypto, Forex, indices or futures, and the last one is commodities. Right, the last one is commodities. Now, commodities, and it can be a bit insane. They can honestly be a bit insane because they move so fast. But you can get consolidation. Now, what do I mean by commodities? Some people might get angry at me for this, but I'm gonna lump gold as a commodity rather than a Forex just because I've got it on my watch list like this. So commodities can be crude oil. Crude oil moves very fast. Let me tell you, crude oil moves very fast, so it's not for the faint hearted and moves so fast. You've got gold, which gold usually moves like quite nice, right? Gold is very trending. It either moves in one direction or another, or it will consolidate and wait for some big news announcement, right? But gold is gold's one of these markets that are very important. Lots of people look at gold, whereas crude oil, you get crazy shit. I mean, this is the market, remember, that went negative. Let me see if I can get this up. It's gonna have to be the futures contract. Let's see if I can get this up. Crude oil, if you remember, during 2020, it went negative. So we get the monthly chart. Now look at this. Below this candle, like minus 40. This went to minus $40. That's insane. Absolutely insane. But yeah, let me tell you something. You're not gonna get the S&P going to minus to $1,000. Yeah, you're not gonna get that. You're not gonna get that. Only in crude oil, Bitcoin, Tesla. I think Meta or Facebook, whatever, dropped like 70% in a month. But you're not gonna get that in the professional markets. And for me, especially as a guy who's a swing trader, who's a swing trader who wants to hold on for a few days, I do not want to be a part of that. I don't want to be a part of the market that moves, insane. But commodities are very nice. They're very nice. If they move, so let's say if there's like, I don't know, something's going on in the Middle East, crude oil will move so fast. It'll move so fast. And similarly with gold, and if anything bad happens in the world, everyone will just buy gold. And this is what's happening now, right? So we get onto, let's say, the daily chart. But look at this, right? Look at this. We're in a massive bull market. Now, a bull market just means price is going up. Let me get this up. A bull market just means price is going up. Like that. I mean, very extreme case here, but I hope you guys understand. That's what a bull market is. And a bear market means price is going down. Right? Don't get confused by the terminology. Terminology is not important. The logic is. So that's a bull market here. That's a bear market. But yeah, gold's moving up because people are buying gold because of I guess like tensions in the Middle East and all that sort of stuff. But we never talk about that. And yeah, commodities are good. You can day trade them and you can swing trade them too. Yeah, swing trading commodities is very nice. Very nice. I mean, you can just look at this, right? Look at all the little dips we have here, right? Buy the dip, right? Buy the dip. Buy the dip. Buy the dip. Buy the dip. And get a little bit here. And then what are we going to do next, guys? Buy the dip. All the way up until $3,000, right? So for those who trade gold, I think we're going to hit $3,000 all the way up here. Okay, so what even is daily bias? Daily bias, in its most simplest form, is just a higher time frame direction. It literally is, where is price going to go on the higher time frame? That's it. It's that simple. Now, why do we care about the higher time frame? The higher time frame move the market. Those who have billions, those smart money, big banks, hedge funds, insurance companies, they only trade on the daily and the 4-hour chart, right? But this is the key chart that all of smart money, everyone with billions are looking at. But we want to ride, essentially, we want to follow the trend that smart money, these big institutions are doing, right? That's what we want to do. So that is why we care about daily buys. And for daily buys, there's 3 things we need, right? Liquidity, number 1, which is by far the most important thing. And then number 2, we use order blocks. And number 3, we look at fair value gap, right? So right here, run GBP USD, run the daily chart. And this exact price action study that I'm going to show you works on any market. So you can replace GBP USD with gold, with yen, with, the S&P, anything, right? Any market, even stocks, crypto, this will work. Now, what we want to do is we want to see, first of all, where is the most obvious liquidity, right? When we're on the daily chart, we want to ask ourselves, where is the most obvious liquidity? And for those who don't know, liquidity is simply just stop loss orders, right? It's just stop loss orders at key lows and at key highs, right? Now, obviously, at this bit of price action, the most obvious liquidity pool, the most obvious, group of stop loss orders is at this low here, right? That's our most obvious liquidity pool. Now, that isn't enough for us just to, short randomly, hoping that we can get lucky, right? Because a lot of traders are like, oh, we're kind of close to this low, price might go to it. That's not enough. Now, liquidity is the most important thing. It's the first thing we look for. But the second thing we need to check is we need to check for order blocks, right? Now, for those who don't know, the order block is simply, when we're bullish, it's the last down close candle before the up move. That is our order block, right? Now, what we want to see is what is price going to do at the order block, right? I'm going to mark out the order block like this, right? Now, if price was bullish, right? If price was bullish, what would happen is price would come down, it would tap the order block, and then it would quickly and aggressively shoot off, right? That is what price would do if we were bullish. Now, if you look over here, let me just make this a bit bigger. Right here is another order block. You see how price moves off massively, it comes down, it touches the order block here, right? Touches the order block and then massively shoots off. That right there is very bullish, and it tells that price action is bullish. But what we want to do, let me just remove this. What we want to do is we want to see what does price do at this order block here. Is it going to respect it? Now, on the daily chart, at this moment in price action, it's very clear to us there's been absolutely no respect for this order block whatsoever. Now, when I say there's been no respect, price has come in aggressively, deeply closed within this order block, right? If it was bullish, it would have shot right off. Now, it's not done that. The bodies have closed within the order block, so wicking super deep into the order block. There has been no respect of the order block, right? And again, those who don't know, respect just means that price hasn't just shot up on the order block, right? We're deep within the order block. There's been no respect whatsoever of the order block. Now, that is exactly what we want to see when we're bearish and we've got lots of liquidity. That's exactly what we want to see, because that just adds to the probability that price is bearish, right? No respect in the order block whatsoever. Because some people will say to me, they'll ask, oh, wasn't there liquidity here? Yes, there was liquidity here. But look at what price does. It taps the order block and then quickly shoots off. That is bullish, right? But here, in this bit of price action, let me just remove this. In this bit of price action, we don't have any of that. So there's been no respect of the order block. We've got obvious liquidity. And I'm just going to check here. We do have a tiny bit of a fair value gap here, but it's already filled. So we don't have any fair value gaps in this bit of price action. But again, you can just look at this fair value gap here, right? We just mark out this fair value gap here. Right. Look at price, wicking through the fair value gap, no respect whatsoever, lots of consolidation in this fair value gap. There's been no respect of the fair value gap. Now, respect in this case would be price touching the fair value gap, quickly shooting off, right? We don't get any of that. Which adds to the probability and tells us that we're bearish, right? We're on the daily chart. This is the most important time frame in all of trading, right? Now, I'm not saying you have to trade the daily chart. I don't trade the daily chart. But, big banks, big institutions, smart money, those who move the market, even the central banks, they're all looking at the daily chart, right? So here we go. So there's been no respect of the fair value gap. There's been no respect of this order block. We have obvious liquidity here. What does that mean? It means we're bearish. Right, we're bearish, and what does that actually mean for us as traders? It means whatever time frame we're going to trade, whether you're a swing trader on the 4-hour or you're a scalper on the 1 minute, we're going to look for shorts, right? We're going to look for shorts, and essentially what we really want to do is we just want to ride price down. Now imagine this is like the 5 minute or whatever time frame you trade. All we want to do is sell every rally, right? Sell every single rally like this, right? Any retracement up, we want to sell like that, right? All the way until price comes down and takes out this low here, right? Once it takes out all this liquidity, all this stop loss orders, then what we want to do is we just want to wait like a day or two to see what price wants to do. Does it want to continue downwards, or is it going to start to reverse in the opposite direction? So we've got our daily bias. If you understand that, if you understand what I just said then, and by all means, replay that, those few minutes. If you understand that, you can predict daily bias for literally any market. Now, what I would say is literally write down on a notepad and the 3 things you need for daily bias. Liquidity, number 1. You ask yourself, where's the most obvious liquidity pool? Where are the most obvious stop loss orders? Number 2, you look at order blocks. Are bullish order blocks being respected? Are bearish order blocks being respected? Yes or no? And then you look at fair value gaps, right? Are they being respected, or is price just going straight through them? Right? And then once you've got all those, the daily bias, the direction of the market is very simple, very easy to predict. And all we're going to do now is we're going to get in a lower time frame, and we're just going to look for any entry pattern. Okay, so here we are on the 15-minute chart. Now, just look at the 15-minute chart, right? If we just zoom out, price is just being bearish this whole time. So any short is high probability. And let me just say something. The entry pattern is the least important thing. And this took me a few years to realize. Once you've got the higher time frame direction, like any short in the higher time frame direction, or any trade in the higher time frame direction, is high probability, right? It's that simple. So all we need is an easy entry pattern, right? Any entry pattern will do. And this isn't the video for entry patterns. We've got so many videos on the channel about entry patterns and liquidity sweep and all that good stuff. I'm just going to give you a really easy entry pattern. So right here, we've got a fair value gap, right? This right here is our fair value gap. Now, price just touches the fair value gap and then shoots off, right? This right here could be your entry. This could be your entry, in London, just before New York, like this, right? Your stop loss at the high here, and then we're not going to target 7-1. What we're going to do is we're going to target at least a 2-1, right? I always target 2-1, like that, like this, or we can target a 3-1, like this, right? Just about getting like that, right? That's what we can do for our entry. So let me just make this a bit more clear about this. Now, for those who are asking, and for those who don't know, when you're a day trader, you want to factor in spread. Now, I don't want to make this video too complicated. What spread really is, it's the difference between the buy and the ask price, bro. And if you do know what spread is for a day trader, I would always say, let's say it's GBP USD. I would always have like 0.5 pips, right, or at least 1 pip, for like my entry, right. So what that would really mean is my entry would be just like this, because the difference between the buy and the ask price, there's a little bit of slippage here. But if you know what spread is, I just have literally a 1 pip, like gap, just do a factor in spread. So anyway, we don't need to talk about that, right? That's not important. The price action is the most important thing, right? You understand the price action, and everything else is easy. Everything else is easy. So that's all we do, right? All we do is we get on the daily chart, right? We get on the daily chart, we look for our bias, and then we get onto the lower time frame, 15-minute, 5-minute, 1 minute, the 1 hour, the 4 hour chart, and then we just look for short, right? That easy, that simple. Now I'm gonna give you another example, but this time it's gonna be bullish. So let's go look for that. Okay, so here we are on the Dow Jones, and this can be the US 30 if you trade CFDs. It really does not matter. And like I said, it works on all markets. But here we are, we're bullish. We've got lots of liquidity here. So liquidity, stop loss orders, whatever you want to call it. Now, what we want to do, we've identified our key liquidity, right? This is our key liquidity. Well, now what we want to do is we want to look at order blocks, right? We want to look at order blocks. And because we're bullish, we're going to look at bearish order blocks. Now, this candle here, the last up close candle before the down move, this is our order block, right? This is our bearish order block. Now, what we want to see, if price was bearish, what it would do, it would tap the order block and it would quickly shoot off like that, right? That is what price would do. Now, let's just look at the price action. Does that look like price has respected it and shot off, right? Does it look like price has hit the order block and reversed? No, not at all, right? Not at all. We've got this candle that's just smashed right through it, and it's almost left equal highs, right? There's been no respect of that order block whatsoever. So that adds to the probability that this liquidity pool is more likely to get hit, right? It's a lot likely that price is going to come all the way up and smash right through this liquidity pool, right, and take out all these stop loss orders. So smart money, those who have billions, can get into their positions or get out of their position. Only reason these markets move, right? Not from market structure, not because of VWAP, not because of level 2 on the 1 minute chart, or, or like, the tick chart or whatever. It moves only for liquidity. So smart money, those with billions, can get in and out of the position, right? It's not designed for retail traders. It's designed for those with billions. But that's just the way the world works. Now, we can either complain about that or we can use it to our advantage. And that's what we do with liquidity. Now, we've got liquidity. We know where the obvious liquidity pool is. We know there's been no respect of the order block whatsoever. The third thing I like to do is look at fair value gap. Now, this is a beautiful example. Let's look at this fair value gap here, right? For those who wonder, this is exactly what I'm talking about by respect of a fair value gap or order block, right? Look at how price taps into the fair value gap, instantly shoots off with a little wick, and it massively, aggressively shoots off in the opposite direction. So let me clear this off. Look at the wick. Look how we whip down, we hit the fair value gap, and we instantly shoot off. Look at that, right? Price went all the way down here. It massively, aggressively went all the way up. As soon as they hit this fair value gap, smart money is buying, buying, buying. And they're buying billions and billions and billions, and they're shooting price up, and then they're going to target this liquidity pool here, right? So we've got our three confluences. We've got the obvious liquidity pool. There's been no respect of an order block. And now, an order block in this case, it can almost act as defense, right? If that makes more sense, right? This order block is almost defending this liquidity pool. Now, it's not done its job at all. It's been completely breached, and this is our most obvious high that pricing goes for. And thirdly, we've got our respect of the fair value gap, right? Complete respect of the fair value gap. Price is bullish, and this is how you determine the direction of the market, right? This is how you determine the direction of the market. We look at the daily chart, we identify our liquidity, we look at order blocks. Are they respecting price? Are they protecting liquidity, or are they being disrespected? And then we look at fair value gaps. Are they being respected? If so, is it bullish or bearish fair value gaps? And then once we got that, we get in the lower time frames and we look for entry. So I'm gonna get the lower time frames. I'm gonna give you a simple entry that we can use targeting this liquidity pool. And like I said, any entry pattern, in this case, it would be buying any sort of dip is good until we hit the liquidity pool, right? And then we just wait for a few days. So yeah, let's get into lower time frames and see what we can see. Okay, so here we are on the 1 minute chart for Dow Jones, and I'm showing you a tiny little, I guess, like education about indices. So my time right now is in New York Eastern time, right? Let me get this in New York Eastern time. I recommend wherever you are in the world, always use this time frame because it just makes it easier for traders across the world to use. So for indices, the lunch time is about 12 to 1 p.m., right? And it usually makes a fake move, right? So we know we're bullish on the overall higher time frame, and then during lunchtime, we get a little bit of a retracement. Now that's very, very typical for indices. Now we know on the higher time frames that we're bullish, so we're only gonna look for long. Now, we have good intraday liquidity around here. Now, what I mean by that is this can be a good target intraday. Now, you don't have to target the daily high, which is all the way up here, right? You don't have to target that because it's unrealistic, especially if you're a day trader or scalper. Completely unrealistic and to get that in a single day. But what we can do is we can just look for an obvious high target when we're bullish, right? On the lower time frame. That's what you can do. Now, for me, personally, I just aim for a free risk to reward ratio. But let's just make this clear. Right here, we've got some liquidity. Right, we've got some liquidity here, which is nice. Now, for me, this is my entry. Wait till you see how sophisticated this entry is. Once I've got the higher time frame bias, once I've got obvious liquidity, all I do is I enter on a Fibonacci retracement or an optimal trade entry, as it's called. So I put my Fibonacci from the low, from the most obvious low to the most obvious high. Because someone's asked me this. The most obvious low, the most obvious high is where I put my Fibonacci, right? That's what I do. Not that complicated. Most obvious low, most obvious high. Then I'm going to enter on a 0.705 level, like this. I put my stop loss at the low. And me personally, right, this is me personally, how I trade. I always target a fixed free risk to reward ratio. So it's just below it. If you really wanted to, this could be your take profit, right? 3.24 risk to reward ratio. If that's really what we want to do. For me, I like to keep it easy. Every single time I sell my limit orders, I take profits at a free risk to reward ratio. I don't need to babysit the trade. I let it do its thing, right? I let it do its thing. Now, for those who are going to ask, I know people are going to ask me, here's my Fibonacci settings here, 0.705 level. That's where I enter at. Now, there's no magic in Fibonacci, right? There's no magic about it. It's not going to move price. The real magic is the liquidity on the higher time frame, right? So the Fibonacci itself, let me just make this clear. This is the real magic, having the daily, the daily direction, the daily bias, right? And then just riding the trend, right? That's the real power in trading that will make you rich. It's not the entry pattern. It's not the Fibonacci. It's not even a liquidity stream, right? But as long as you got the higher time frame direction, you got the daily bias correct, trading is so easy. It's honestly so easy, right? And look how easy this is, right? We've got the higher time frame direction. All the work's done on the higher time frame. When we get the lower time frame, all we're doing is looking for our entry pattern, right? The entry pattern is the least important thing. The daily bias is so important. But I hope this video has explained clearly what daily bias is, right? Daily bias is so important, but once you've got daily bias and once you understand it, it's nice and easy. So to summarize, all we do is we look for liquidity on the daily chart. Then we look for our order blocks. Are they being respected or not? Are bullish order blocks being respected, or are bearish order blocks being respected? And then lastly, we look at fair value gap. Are they being respected or not? Right? That's it. 3 things that you need to look for daily bias. That easy, that simple. Okay, so what is a liquidity sweep? A liquidity sweep in its most basic form, it's a fake move, right? It's a stop run in the opposite direction of the higher time frame. Right? So let me say that again. A liquidity sweep is a fake move and it's in the opposite direction of the higher time frame, right? The move is designed only to take out stop loss orders. So what that means is when you're in a bullish market, like we are for gold, and this works on all markets, by the way, but for gold, we're bullish. And to determine if we're bullish or not, you need to use liquidity on the higher time frame. Now, in this video, I'm not going to discuss that because I have so many videos on the channel discussing that, so make sure you check them out. But assuming you're bullish and you've got the higher time frame direction, the higher time frame bias, whatever you want to call it, what we want to look for is suppose price comes up, price moves down, retraces down. Lots of people are going to put their stop loss orders here, thinking it's safe, and then they're going to buy any sort of dip. Right, price comes down, it just takes out their stop loss orders here, and it quickly moves off like that, right, in the opposite direction, and then it retraces, allowing smart money traders, those in the know, start entering around here, right, at a fair value gap, order block, and optimal trade entry. Anywhere around here is where all those traders in the know who are waiting for this liquidity sweep, for this fake stop room, they're all entering around here. They're buying, and then price massively moves off. Great to take profit, right? That is what a liquidity sweep is when you're bullish, right? And this must have happened to you so many times. It happened to me all the time. I forget the direction of the market, right? But I just couldn't make money. And I couldn't make money because I'd have my stop loss here, price would come down, it would take out my stop loss and then quickly go to my fake profit. And if you've been trading for a while, that must have happened to you so many times. And it's the most frustrating and annoyingest thing in trading. And the reason it is because you haven't waited for a liquidity sweep, right? So we have to wait for a liquidity sweep. And if we don't wait for a liquidity sweep, you're going to be the one getting swept, because that's what a sweep of liquidity really is, right? Stop loss orders here got swept and then price quickly moved on. Now, on gold, run the 1 minute chart. And let me just say this, because I have to say this every video because people keep asking me this. First of all, it works on every single market. So gold, Forex, indices, futures, crypto, stocks, penny stocks, any financial market that has candlesticks, this liquidity and liquidity sweep will work, right? It's rooted on deep logic and that actually moves the market. And second of all, it works on all time frames. But what I will say, this is so important, the lower the time frame, the more significant, or at least the more often you'll get liquidity sweeps. So the more entries you'll get, right? That's what I'm really saying. So run the 1 minute chart for gold, and what we're gonna do is I'm gonna make this a bit more bigger. You see this move here, right? You see, right, we're bullish on gold. You see this move here? Let me make this so clear. You see this fake move here, price quickly moves down, just to take out these stop loss orders here, right? Anyone who trailed up their stop loss from here to here, any stop loss orders that were here got taken, right? Price just came down, it quickly, aggressively moves off in the opposite direction. That right there is our liquidity sweep. And then any retracement after the liquidity sweep is high probability. And then we just ride price up, right? We just ride price up. That is essentially what a liquidity sweep is in its most basic form, right? And that's what we see in price action again and again and again. You see that over and over again. And you don't, listen, I'm an ICT charter student. I've been through literally all of his videos. You don't need anything apart from this, like liquidity sweep and then any entry after retracement. You don't need a market maker model. You don't need inversion fair value gaps. You don't need any of that. You don't need any of that. You need simple trading that you can trust. So this is all we need, right? This is all we need. This is our fake stop. So let me just make this clear. This is our liquidity sweep right here. Right here is our liquidity sweep. So let me write this out inside, just so it's super clear. So liquidity sweep, and we always wait for this before we enter, right? Liquidity sweep. You can call this a stop run as well, right? So if that makes it easier for you, let me just make this very clear, because some people are just gonna be like, and they just don't like the term liquidity, right? You can call this a stop run. Just make this so it comes down like that, right? You can call it a stop run, whatever you want to call it, liquidity sweep, stop run. And what it is just a fake move in the opposite direction, purely designed to grab stop loss orders, right? So it could be a liquidity sweep or a stop run. The exact same thing, as long as you understand what it actually is. And the reason why this works is for smart money, this entity that has billions of dollars to get into the market. And there's two things they need to do. They get the majority of their orders on the higher time frame, right? On the 4-hour, daily, weekly. That's why we look at the higher time frames for liquidity, because that's what smart money does. The second thing they do is they don't, like, the humans don't trade the lower time frames. Their algorithms, their bots trade the lower time frames. This is why some of you might be thinking, okay, how many stop loss orders are there realistically at this low, right? Like, who's going to put their stop loss orders in? Me and you probably won't, but algorithms are coded to put their stop loss at highs and lows, right? Like, at lows here, highs here. They're coded just to do that, right? So there are algorithms that literally, they have a 51% win rate and a 1 risk reward ratio, but over like 1 million trades. That's a lot of money, right? But these are algorithms that just, they're coded to fire trade. So smart money, their algorithms are designed just to take out stop loss orders, and then buy, right? So what that means is, let me just move that there. What this means is we've had our liquidity sweep, we've had price quickly move off in the opposite direction. And this is so important. People ask me like, is it a liquidity sweep around here? What if it keeps going down? No. It's only a liquidity sweep when price massively moves off in the opposite direction. That is when it's a liquidity sweep. I don't know, like when price comes down here, I don't know if price wants to come all the way down here. Only when price massively moves off in the opposite direction do I know it's a liquidity sweep, right? Hope that makes sense. Only then do I know it's a liquidity sweep. And then I'm just looking for any entry. Any entry afterwards will do, right? We don't have to. And so many people get this wrong. They try and finesse the entry. They ask, hey, what breaker block do you use? Do you use inversion fatality gap? You know, ICT's released this new PD array. You don't need any of that. All you need is a liquidity sweep and a simple entry. And I'm going to show you, and I guess I'm just going to show you a few entries actually, just because. And there's 3 entries that I always vouch for. If you watch this channel and for a while, there's 3 entries which I love. I call them the 3 golden entries, and they are the optimal trade entry, the order block, and the fair value gap. Now I'm literally going to give you each one an example of each one on this bit of price action here, right? If that makes sense, because any entry pattern will do. But for me personally, I just take a Fibonacci retracement or an optimal trade entry, which is I put my Fibonacci, and to get the Fibonacci right, all you need to do is come to the top left here, right, and then on your indicators, just look for Fibonacci retracement, not this one, Fibonacci retracement like that. And if you press start on TradingView, you can get it. You can get it here, right? Same thing with the risk to reward tools here. So for those who are asking, some people still do ask me this. You want a long position, you come on the projection part, long position, short position, press the star, right, the star here, and then you'll get it here, right, like that. So nice and easy. Anyway, so what you do, right, is you enter like this, right? You enter like this, right, like that. That's your entry. You put your stop loss at the low, and then you target a free risk to reward ratio like this, right? You guys get the point. Now, some people are going to be asking me, they're going to be asking, oh, and I'm going to keep saying this, oh, you know, should I put my stop loss here? Should I put it here? Should I put it at this fair value gap here? At the, you know, the low of the order block? You always put it at the low where the liquidity sweep was, right? That's the whole point in waiting for a liquidity sweep. Like, why would we wait? Keep asking yourself this. Why would we wait for a liquidity sweep? Right? Why would we wait for a liquidity sweep if we're not going to put our stop loss low at the liquidity sweep? Like, what's the point in that? Like, why would we put our stop loss here? Right? The whole point of waiting for a liquidity sweep is that we can put our stop loss order, or at least our stop loss, in the safest place possible. Very safe, because very unlikely, if this was really a fake move designed to take out stop loss orders, that pricing would come all the way up here, come all the way down again, just to take out more stop loss orders, and then move off. Very, very unlikely that's going to happen, right? But that's why we always put our stop loss orders right at the low of the liquidity sweep, right here. We always put it there. We don't try and get some crazy risk to reward ratio. We put it at this level. It's nice and safe. And then I'm a big believer in this. Just aim for a 3-to-1, right? You don't need a 4-to-1, and you can aim for a 2 risk to reward ratio. But for me, I just aim for a 3 risk to reward ratio. And let's just replay this, right? I know a lot of you are going to want to just see what it looks like in live price action. So imagine this is price action live, right? You're on the chart. This is what I'm looking for. Now, some people might be asking, oh, you know, there's another little swing low, swing high here. Look, listen, I can tell you from years of trading, just ditch market structure. Please just ditch market structure. I have so many students, right, who understand liquidity. They finally understand liquidity sweep, right? And they're like, they see price action like this, and oh yeah, you know, oh, I'm going to enter. And then they don't enter because there's some sort of market structure shift on the 1-minute chart, or this swing low was taken. Honestly, just completely forget about market structure. I know it might be hard and stuff. Just forget about it. It's a waste of time. It's a complete waste of time. Goldman Sachs aren't buying because there's a market structure shift on the 1-minute chart, right? They only buy because of liquidity on the higher time frame, and we just trade that direction. So ditch market structure. So it's so many people DM me. I'm not even joking. So many people DM me. They get this right. They would have made money, and they keep telling me, "Oh, I didn't take the trade because I was afraid to lose. I was afraid because of this market structure shift." Ditch market structure. All you're gonna do at this point, set your limit orders here, right? So you set your limit order. You enter at the 0. Let me make this very clear. We enter at the 0.705 level. This level here, right? That's all we care about from Fibonacci. This level here, we're gonna enter, and you can remove the 0.5 level. You can remove all these. All we care about is the 0.705 level. Then what you're gonna do is you're gonna put your entry here, stop loss here, take profit here, and you're just gonna wait. If price, and people are gonna ask me this, if price breaks this high, or it comes down here, right? So it breaks up this high, then I'm gonna put my Fibonacci at the new high, right? If that makes sense. So what I would do is I'd move the Fibonacci like that, right? Nice and easy, right? So it's not nothing crazy, but we're just gonna wait for a retracement. So let's just play price action like this, right? Like this. And this is real trading. I want to give you guys a real example. Not every trade is gonna come like this, right? And go straight up, right? If these gurus are lying to you, let me tell you that. Let's just read right here. This is a real trade. You're on the 1-minute chart, right? You've got a bit of retracement. Lots of people are gonna panic here. They're gonna panic here. But I just let price do its thing, right? We hit take profit. Let price do its thing. It's the 1-minute chart as well, guys. So literally, this is like an hour, right? You're risking 1K, you're gonna make 3K in an hour, right? Who's angry with that? So, this is real trading, guys. Real trading. You're gonna have some consolidation. Price gonna chop around for a bit before it hits your take profit. Key thing is, don't get emotional. Don't start taking partials. For those who ask, I don't use partials, and I do move my stop to break even once price breaks this level here. So once price comes up to here, I move my stop to break even like that, right? Like that. But I still my pre-risk reward take profit, but my stop loss goes to break even at this point because almost always it hits my take profit. Maybe like 1 in 20 times it will come back and hit, I guess, my stop loss. So yeah, that's the optimal trade entry. I'll give you the order block and fair value gap entries now. Okay, so for the next example, we're going to use an order block. Now I'm not going to do the replay and stuff. We don't need that. But this right here, let me just mark it out. The last down close candle before the up move is your order block, right? Last down close candle before the up move is your order block. Now first of all, just look at this, right? Look at that. Look at the wicks respecting. Look at the bodies respecting this order block, man. And how crazy is that? That's absolutely insane. The wicks tap in and then quickly move off. Now people ask me this all the time, right? A high probability order block, price will do that. It will tap up, it will tap it and then quickly move off in the opposite direction. A low probability order block, price will do this. It will deeply retrace, start consolidating a bit and then slowly move out. That is a low probability order block. We don't want to do anything with that, right? That is a low probability order block that we want to avoid. Now, in terms of entry, this is literally the highest probability order block you can get in all trading. You have a liquidity sweep and you've got a fair value gap attached to it. It does not get cleaner than that. So what we're going to do is we're just going to enter like this, like this. I'll stop loss at the low. And then for take profit, I would say obviously at least a 3 risk to reward ratio. And look, this, if you want to like pass a prop room challenge and you're willing to take the risk, aim for this high here, right? Aim for this high here, right? We're on the 1 minute chart. It's quite likely if we're bullish that we're going to hit this high here. So if I wanted to pass a prop firm, and I'm not advocating to do this every single day or every single time, but if I really want to pass a prop firm, I want to make a lot of money and I was willing to take the risk, by all means, go risk 1% on this trade here, and you probably get it, I'd say 9 times out of 10, with all disclaimer, right, with the higher time frame bias and liquidity sweep. Yeah, and then for fair value gaps and fair value gap entry, what we're going to do is you're going to enter this fair value gap here. Now, let me just make this clear. See, price doesn't even touch it here, so we are good. If price did touch it here, so let's say if price touched it like around here, what we would do is the bit that's remaining would be our fair value gap. But we're okay in this case. This is our this is our fair value gap, right? This is our fair value gap. Now look, right? Price wicks below the fair value gap because it's quite narrow, but it's wicking into the order block. So we are okay with it. But anyway, you wouldn't know that in hindsight, right? You're not going to know that price is going to do that. You're just going to buy as it comes down here. And this is why I'm a big believer in not having such a tight stop loss. Because so many people are like, I put my stop loss at the fair value gap. Like, why? What? The whole point of waiting for this liquidity sweep is to put our stop loss in a safe place where we know it's very unlikely the price is going to go to. And then for take profit, what we're going to do is, I wouldn't aim higher than this here. So here we go, 4.3 risk to reward ratio. And if you want an easy take profit, 3 risk to reward ratio, like that. Look at this, right? You entered at 4:21 a.m. and then 4:29 a.m. It's like 8 minutes. 8 minutes, you can make 3K. Pretty good life, boys. Pretty good life. And by the way, people are going to ask me this all the time. This is in New York Eastern time because this is how the markets operate. So this right here would be a London strategy, but it works in literally any session. So London, New York, and Asia. It works in any session. It works on all markets. It works on Bitcoin because I know a lot of people, at least a few people, are really interested in crypto. It works on crypto. This exact same thing. Forget gold, right? Forget this. Just put like a market over this, and like a black market over this and this, and this concept would work. This concept works on any time frame, and it works on any market. But don't overcomplicate it, guys. Don't ask, I've only seen examples on gold, but does it work on GBP, JPY? Yeah, it works on all markets. So yeah, liquidity sweeps may be profitable instantly, and they will make you profitable. It's honestly the highest probability thing I've ever seen in trading, and I've taught so many students this, and they've made money right away. Right, I've got one student who made 20K, I think, in a month, which is insane. Okay, so we're on gold, and this works on all markets, by the way. Any financial market, liquidity works on. And so we're on gold, we're on the daily chart, and to do this, to do any sort of liquidity analysis, we need one higher time frame and then one lower time frame to enter on. That's it. The higher time frame gives us our direction. The lower time frame we use for entry. It's that simple, right? And you don't need to use the weekly, daily, 4-hour, hourly chart, all of them combined. You just need to use one time frame. So we're gonna use the daily chart because this is what all smart money are looking at, right? Goldman Sachs, JP Morgan, all of them are looking at the daily chart, and they're looking at the daily chart for one simple reason. They have billions of dollars to move into the market. They cannot do it on the 5-minute and 1-minute chart like we can, right? And the only way they can get into the market is if they essentially trade or get into their positions where there's lots of money. Now, where there's lots of money, that's what we call liquidity, right? Liquidity means how easy it is to get in and out of a position. right? And it's easy to get in and out of a position because there's lots of stop loss orders. There's lots of money there. So right here, we've got triple highs of gold. We've got one high here, and we've got a third high here, right? Lots of people are going to think, right, like price did here. They're going to think, right, that price, because price came down, and when it comes up again, it's going to come down. They think this is really good resistance, right? They think this is really good resistance, support and resistance. We all try this as beginner traders, and we weren't profitable with it because it does not work, right? It does not work. That's not why the markets move. The markets only move for liquidity. And if you'll notice, you might be saying, oh, well, it worked here, right? It worked here. Price came up and it bounced off and went down. The only reason price did that was to get more and more people shorting gold, right? If you just zoom out on the daily chart, we're a massive bull market in gold, right? So the only reason price did that was to get lots of people to stop shorting gold, right? So we know at these levels here, there is so much liquidity. Let's just move this down. There is so much liquidity, right? There's so many stop loss orders. There's so much money, right? There's billions and billions and billions of dollars worth of stop loss orders, all at these highs here. So what smart money are going to do? Smart money, this entity that actually moves price, what they're going to do is they're going to force price up to these highs. And then once price is in these highs, they can start buying and selling. Whatever they want to do, they can get into that position because there's billions of dollars there. They cannot get on the 1 minute chart and just press, buy and sell like we do, right? They don't have the luxury of doing that. They can't just buy randomly. They can only buy at certain areas because they put so much money to move into the market. So the only thing we use for liquidity, right? This is all we need to do for liquidity is we just need to target it, right? We get on the higher time frame, we find the obvious, like the next obvious liquidity pool, and we just target it. We use it to give us our direction for the market. That's it. It's that simple. We don't need to do anything crazy about liquidity. So right here, we know, right? We know that price is going to come up and it's going to come and take out these highs here, right? Price is going to come all the way up, like it's on here, all the way up, take out all these stop loss orders, and then we don't know what price will do next. It could continue up like this, right? Continue up and then go to all-time highs, or what it could do, right? What it could do is price could come up, take out these highs here. Smart money can get into their position, and then it could consolidate. It could reverse a bit and go down. Like who knows what can happen? But what we do know is that at key highs and key lows, smart money will move price there so they can get into that position, right? That's what we know, right? So that's the only reason why these markets move. So we've done our liquidity analysis on the daily chart. We know that price is bullish. We know that price is going to come all the way up and to take out these highs. All we need to do now is get on the lower time frames and look for a simple entry pattern, right? And then we combine the entry pattern with a liquidity sweep to give us the highest probability trade possible. So let's get onto lower time frames and look for a simple entry pattern that's bullish. Okay, so run the 1 minute chart, and you can do the exact same entry on the 5 minute or 15 minute chart, or even the hourly chart. So here we are on the 1 minute chart. If we just zoom out and we zoom all the way out, this is that key daily high liquidity pool. Now we don't have to target this on the lower time frames. We don't have to target this. We just need to trade in that direction, right? So we only use the higher time frame liquidity just to tell us that we're bullish. So all we need now is our entry pattern, and right here. And this is so important. This is probably the most misunderstood thing in all trading. Right here, we have something called a liquidity sweep, right? Now, a liquidity sweep is essentially, now we know that we're bullish. We did the work on the higher time frames. Essentially, let's say we have some bullish price move up, right? Price comes down, it just wicks down, takes out your stop loss, and then instantly moves up in the opposite direction. That right there is a liquidity sweep, right? It was a fake move. This move here was a fake move designed just to take out stop loss orders. And then any retracement after a liquidity sweep, right? Super high probability. So we want to enter any point around here, right? Very safe place to put your stop loss here because it's already taken out stop loss orders. Then you want to ride price up. That is what liquidity is as like a basic overview. And it's literally the best entry in all trading, right? I've traded for years, 4 years. I'm an ICT chart student. That is the best entry in all trading. It took me at least 2 years to figure this entry out. And then it took me years to actually master it. But nevertheless, here we are, right? So right here is a liquidity sweep. You see, let me just make this clear. You see how price comes down, it takes out an old low, quickly and aggressively moves off in the opposite direction, right? That is our liquidity. And then any retracement after that is high probability. Now, you might be asking, let's remove this. You might be thinking, oh, well, there's probably not much, not many people are going to have their stop loss orders at this amount. Now, you're going to be right. There might not be many people who have their stop loss orders here, but there are so many algos that are coded to put their stop loss at key high, or not at key highs, at any high, any swing low, right? They're coded just to keep buying, keep buying, selling out, highs and lows. That's, 70% of the volume of these markets are all algorithmic, right? So there are algos that are literally 51% profitable. Their win rate's 51%, and they get a 1 risk to reward ratio. But they make like 1 million trades in a day. So, over the long run, or over 1 million trades, they are like quite profitable. But anyway, at highs and lows on any major financial market, like gold is one of the most highly traded markets. There are spots are at every high and every low. So there is liquidity here, right? Now it's not as much as like the 4-hour or daily chart. There is enough liquidity here for it to be a liquidity sweep. So right here is our fake move, right? Fake move. Look at this wick. This wick only comes down to take out this low and it instantly and aggressively moves off. It's literally gapping, right? We've got a gap here. Price is literally gapping up just to move off, right? That is our liquidity sweep. That is the best thing we want to see in trading, especially when we're bullish. So we've got our liquidity sweep. Put that down there. We've got our liquidity sweep. Price quickly and aggressively moves off in the opposite direction. Now, I mean, I don't look at marking structure, but if you do, here's your marking structure shift. All right, let me just mark this out. I don't look at market structure because I think it's a bit of a distraction because liquidity is all you need. The moment this body essentially, or this body really, once it closes above these highs, that's your market structure shift. I don't look at it personally, but if you want to, there's another thing that will add to the probability. And all you need is any sort of retracement afterwards. Once you've got this, like this whole framework of liquidity on the higher time frame, that gives you your direction. Liquidity sweep on the lower time frame, price has moved in the higher time frame direction. Any entry pattern after that, any entry pattern on the retracement will do. So I'll give you literally 3 entry patterns here. So we've got a fair value gap. It's just the gap between this candle here and candle there, right? The gap between this candle and this candle. That's a fair value gap. You could enter on that fair value gap, right? That could be your entry. You could, I mean, look at this, right? Look how it's always beautiful, isn't it? Look at how the bodies are like holding in the fair value gap, right? Look at that, and then the wicks are like poking out, right? This look for your nose. The wicks do the damage, and the bodies tell the story. The body is smart money. The wick are retail, right? These are retail traders randomly buying and selling for no reason because they only look at the 1-minute chart. Smart money are the bodies, right? The body is smart money. So yeah, it's pretty interesting how like the price was just holding in that fair value gap. Like it wicks out, but the bodies are in the fair value gap. But anyway, doesn't matter, right? Another entry pattern can be this little gap here. Now, for those who know, this is called a volume imbalance, or at least I call it a volume imbalance. Now, this has so many different names. Someone on Twitter was asking me about this. I had no idea what he was talking about, but he was actually talking about this. Does not really matter. You very rarely get this, right? You very rarely get this entry pattern here. So, I would personally say not to have that as your entry. But what I would say is this right here, this volume imbalance, where it's just see these 2 wicks and there's no bodies overlapping. I'm gonna try not to put my cursor right because it does that thing, but you get what I mean, right? You get what I mean? See these 2 wicks overlapping because there's only wicks overlapping and there's not like a body that there is for a fair value gap. That means that volume imbalance is a stronger draw than a fair value gap. Now, what that means is that price is more likely, it's more likely to come to this volume imbalance than it is to a fair value gap, right? A volume imbalance is a lot stronger than a fair value gap. It's a lot more important. So that's what I think. It's a bit interesting, but it's not really that important. The last entry, and I think this is probably the best entry, just by looking at the price action, if I was on the chart, is you see this order block here. The last down close candle before the up move is your order block. Now, there's 2 ways of entering on the order block. The first is the wick, right? So people could, let me just mark this out, right? People could say this entire thing is the order block, right? And then they could enter right at the wick high and put their stop loss. You'd have to put your stop loss at liquidity sweep low, but they would say that's an order block. That's true. You can enter on that. Me personally, I always like the bodies of an order block, especially when it's quite a big body. The only time I'll ever use the entire order block candle is, let's say it's a doji. Let me try and draw a doji out, right? Let's say you've got like this gonna be awful in it, but let's just imagine like this was like the body, right? The body was like here, a tiny little body, and it had like, it's got huge wicks. Like if it's a huge doji sort of candle, then okay, by all means, use the whole thing. But right here, the body is the most important part. So for me, I'm just gonna enter like this, right? On the order block body. Now, for your stop loss, it's so important. Stop loss always has to be at liquidity sweep low. Always has to be there. Because I always say this, but I'm going to keep saying it so everyone watching this is profitable. Very, very unlikely, right? At price, because price came down, just take out stop loss orders and then moved up. Very unlikely price is going to come down, take out stop loss orders again, where it's already done that. The whole point of price coming down here was just to take out stop loss orders. It's very, very unlikely that price is going to come all the way down, take out your stop loss, and then move all the way up, right? That is the power of waiting for a liquidity sweep. Because how many times, this used to happen to me for years, let's say you were bullish on the higher time frame, you kind of understood liquidity, right? You kind of understood, okay, I just target highs and lows on the higher time frame. It's pretty easy. You get the direction, right? Then you'd buy as price comes against you. Price would take out your stop loss and then instantly go to take profit. The reason that happens, and it's so annoying, is because you don't wait for a liquidity sweep. So once you wait for a liquidity sweep, you're good to go. So any entry pattern will do. Stop loss always at liquidity sweep low. And then the take profit. For me, I always say this, I just aim for a 3-to-1. I never aim for more than it. If you're on the 1-minute chart, I guess you can, right? And if I was on the 1-minute chart, just looking at this price action, I would aim for this high here. Right? I'd aim for this high here, right? Lots of liquidity at that high. let's just aim for this high. What do we get? We get about almost a 5 risk to reward ratio. Now, I'm not advocating like to always, aim for like a 5-to-1. But, if you were doing like a prop rim challenge or the past in a week, not the worst idea in the world, especially when you've got all this framework behind it, higher time frame bias, lower time frame liquidity sweep, and obvious strong liquidity. You can do it. And this is so important, right? The only thing I'll say, right, is do not aim, let me just remove this. Do not aim for the key daily target, unless it's really like, it is likely for the day. Do not aim on the 1-minute chart to try and target this, right? Because it's insane. You don't need to do that. The only reason we use the daily chart or the 4-hour chart for liquidity is to give us a direction, right? That's it. Now, if price was all the way up here, then yeah, by all means, just target around the 1-minute chart. But price is all the way down here. Don't hold for like, weeks trying to get to this position. You don't need to do that. You just need a free risk to reward ratio. And for me, because I think that's like the golden zone, but with this strategy here, you can get an insane win rate, absolutely insane win rate. And the good thing is, if you're on the 1-minute chart, I mean, you can almost find a setup every day. Now, I'm not saying to trade every day, obviously, but you could find a setup almost every day, especially if you have like 2 pairs as well. Okay, so for this model, all we need is the 4-hour chart, which is our higher time frame chart, and the 15-minute chart for our entry, or the 5-minute chart, right? If you like the 5-minute, by all means, use the 5-minute chart. I'm just going to give you a 15-minute chart example because I have so many new traders and the 15-minute chart makes it easier. But literally, all we need to do is we get on the 4-hour chart and we mark out our fair value gap, right? Now, fair value gap, for those who don't know, it's the gap between this candle here and this little red doji candle here, right? The gap between this candle and this candle here is our fair value gap, right? And what we're going to do is we're just going to wait for price to enter the fair value gap, right? Once it enters the fair value gap on the 4-hour chart, what we're going to do is we're going to get on the 15-minute chart. And what we want to see, really, is we want to see price on the 15-minute or 5-minute chart hit the 4-hour fair value gap, shoot off massively, and then retrace. And then on the retracement here, we want to enter on a new fair value gap that forms, and then we ride price up like that, right? And what that does is it gives us confirmation on the lower time frames and telling us that we're on the right side of the market. So let me get on the 15-minute chart and I'll show you exactly what I mean. Okay, so here we are on the 15-minute chart. Now, you can do the exact same thing on the 5-minute chart, but for this example and in the PDF, I'm going to give you the 15-minute chart. Now, all we want to do is, first of all, we've got our 4-hour fair value gap that we marked off on the higher time frame. And what we want to see, and what we do see, is you want to wait for price to retrace into the fair value gap. And then we want to see it shoot off, right? We want to see price shoot off massively and then leave a fair value gap right here. And then we want to enter on the retracement, right? This fair value gap here. We want to enter on that fair value gap and ride price off. Now, the reason why this works is it gives us confirmation that we're on the right side of the market. Because how many times you think you've got the bias right and then price will come and take out your stop loss, right? So for this model, what we're doing is we've got the highest time frame, the 4-hour fair value gap, and we get lower time frame confirmation because we're waiting for a new fair value gap to form on the lower time frame. So let me just clear this off. And what we're going to do is once price on the 15-minute chart or the 5-minute chart retraces into this fair value gap, this 4-hour fair value gap, we're going to wait for the first fair value gap that forms on the 15-minute chart in the overall direction, right? In the overall direction of the 4-hour chart, the 4-hour fair value gap, right? So price retraces and then bam, we get a big, strong, bullish fair value gap here, right? A big, strong, bullish fair value gap like this, right? This is our bullish fair value gap. And look how strong, look at these little candles here, little dojis, little small candles slowly coming in and then bam, aggressively moves off, right? That right there is smart money telling you, right? Telling you the real direction is bullish, right? The real direction is bullish. We've got our confirmation. All we want to do is we want to enter on this fair value gap here and then ride price up, right? That's what we want to do. Simple, easy, bread and butter model. And this model, by the way, works on all assets. So Forex, gold, indices, crypto, stocks, any asset that you can trade, and it works on it. So for our entry, literally all we want to do is we want to enter on this fair value gap here. And we're going to put our stop loss either at this low here, you want a safe stop loss, or if you really want to, you can put it at this low here. Now, it has to be at a minimum, your stop loss when you're entering the fair value gap. It has to be at the low of the candle that forms the fair value gap, right? So you can't put your stop loss here. Some students tell me, oh, can I put my stop loss here at the fair value gap? No, you can't do that because price could, and it's not, it's not too likely, but price could definitely build the fair value gap in and then move off like that, right? And literally just take out your stop loss, right? But for this model, we don't need a really tight stop loss. We don't need to finesse our entry. All we need is consistency, right? The real secret to trading and profitable trading is just a consistent model that you can rely on day in, day out. So for your stop loss, and you can put it here, or at a minimum, you're going to put it at this candle here, right? The low of the fair value gap, this candle here. And then what we're going to do is we're going to target at least a 2-to-1, or in what I normally do is just target a free risk reward ratio like this, right? So we're going to target a free risk reward ratio like that, right? You guys got the point, don't you? And everyone's going to play price action. And there's only like 3 candles because I want you guys to know what it's like in live trading. But I literally saw it. I was watching this live in London session, so I wanted to give you guys this example. But literally, all we're going to do, wait for the retracement and then wait for the price to shoot off, right? And I literally saw this live in price action, and I thought, you know what? Let me just make a video on this because I fucking love this model. But look at that, right? Look how strong and aggressive these candles are, right? This is how you know you're on the right side of the market. I mean, let's just zoom out a bit, right? Yeah. So if you just look at price action, you've got strong. Look how strong those bullish candles are. Strong candles, and then we get consolidation. We get chop, consolidation, slowly move down. Look at these slow little bearish candles slowly move down into the 4-hour fair value gap. That's what price goes. It massively moves off here, leaving a fair value gap. We enter on that fair value gap, and then price massively and aggressively shoots off. Right? This is such a good model because we've got the higher time frame in our direction, right? We're using the higher time frame and we're using confirmation on lower time frame. Most people use one or the other. They think they've got a daily bias. They come into London session and then it's completely wrong. Or they're looking at the 5-minute chart and they think, oh, you know what? There's obvious liquidity at this high and then price reverses on it. Right? We need both time frame, both the higher time frame and the lower time frame to be profitable. But this model is so good. It's so good. It's so easy as well. I hope it's really easy for you guys to understand. And if it's not, there's more examples, screenshots and everything in that document down below. But you can do the exact same thing on the 5-minute chart. The exact same thing on the 5-minute chart. And in fact, I'm going to give you guys, as a bonus, I'm going to give you guys an example on the 5-minute chart. Okay, so literally on the exact same trade that I gave you, there's an example on the 5-minute chart. Let me just get the 15-minute again, like this, right? And the reason I say the 15-minute chart is it's really helpful for new traders, right? There's lots of new beginner traders and the 5-minute is faster. But if you're used to trading the 5-minute chart, where I was a day trader or scalper, I used to use the 5-minute chart. By all means do it, right? But this is the 15-minute chart. I've shown you guys the logic, which is we're waiting for price to hit the 4-hour fair value gap, waiting for it to move in the direction of the 4-hour fair value gap, and then we want to enter on a fair value gap, right? Lots of fair value gaps there, but I hope you guys get the point, man. We're just waiting for confirmation. Now, let's say you are, Atif, the 15 minutes too slow for me, and I want to get on the 5-minute chart. What you're going to do is you're going to get the 5-minute chart like this, and you're going to do the exact same thing. The exact same thing. You're going to mark out the fair value gap, and this time on the 5-minute chart, like that. And then what you're going to do is you're going to enter, like that. You're going to put your stop loss at a minimum, this low here, right? The low of the candles that form the fair value gap. I know we've got a little doji here, but this low here, you know, you're going to put your stop loss. Now, you can, if you want to be really safe, put it all the way at this low, but this is completely fine, right? And then what you're going to do is you're going to target 2 to 1, 3 to 1. And, if you watch the channel for a while, I always say don't target more than 3 to 1, but I'm not condoning this. I'm not saying to do this, but if you wanted to pass a prop firm challenge, you could aim for a 4 to 1. And, if you had really big balls, you could risk 2% and pass it, in one trade, right? In one very high probability trade. Now, I'm not saying to do that, but, sometimes I risk 2% if I really want to quickly pass a prop firm challenge. But if you wanted to pass it in one trade, and you're like, you know what, fuck it, then let me just risk 2%, and either pass or fail. This is the trade you want to risk on. Right? This is the trade you want to risk on. But this exact model is, it works on all time frames, but the 5-minute and 15-minute chart, the 1-minute chart I would personally avoid, especially for Forex, because it's quite unreliable. If you're trading indices, and let's just zoom out here. Let's say this was the 4-hour chart this was the 4-hour fair value gap on the S&P or Dow and Nasdaq, and this was the 1-minute chart. By all means, use it on the 1-minute chart because indices move very, very fast, right? And during the indices open sessions, so 9:30 to 4 p.m. Eastern. Okay, so what is an order block actually? An order block is simply the last up-close candle before the down move when we're bearish, right? So literally all it is this candle right here. So I'm going to mark this out. This is what an order block is. It's the last up-close candle before the down move when we're bearish. And when you're bullish, it's the last down-close candle before the up move, right? So this right here, this little candle here, would be our bullish order block. Now, that alone is not enough to make you money. You're not going to make money just by knowing that, because that's not enough for order block. There's 2 more things you need to look for. But just look at this, right? This was a so-called bullish order block that failed, and it failed for 2 reasons. The first is that we didn't have a liquidity sweep. So what actually is a liquidity sweep? Because this is the most misunderstood, but probably the second most important thing after liquidity itself is a liquidity sweep. Now, a liquidity sweep is a fake move designed to take out stop loss orders, right? That's all it is. Let me just zoom out and make this a bit more clear. So at this high here, lots of people, right, as the S&P was getting shorted, they would have sold, and they would have put their stop loss here, right? They would have put their stop loss here. They thought, you know what, price has gone down massively. Very unlikely that price will go all the way up. Now, We low, and if you know about liquidity, especially on the higher time frame, the S&P is bullish, right? It's bullish overall. So smart money are going to force price upward, but we don't need to know that. All we do need to know is that there's lots of liquidity at this high. So what price always does, and you will always have this, is it comes up just to here, just to take out anyone whose stop loss orders were here, right? Anyone who had their stop loss orders here, price comes up, it pokes them out, then it goes in the other direction. That right there is a liquidity sweep, and any retracement after that is such a high probability entry. It's insane. Now, for an order block, right, the first thing we need to look for is a liquidity sweep, right? It's the first thing that we've got. The second, and I always say this to my students, is let me just remove this gap here. We want to look for a fair value gap, right? Now, fair value gap, simply the gap between this candle here and this candle here. So I'm going to mark it out just to make it clear and then remove it. So we're not going to enter on the fair value gap. We don't care about that. But when you've got an order block that's also formed after a liquidity sweep and has a fair value gap attached to it, let me tell you something. That is literally the highest probability order block and probably one of the highest probability entries in all of trading, right? That's such a good high probability, easy entry pattern. And yeah, all you're going to do, right? All you're going to do is once you're at the fair value gap, and we don't need to, we don't have to care about the size of the fair value gap, anything like that. But all we need to see is a fair value gap and a liquidity sweep. What you're going to do is literally enter on the order block. Now, this is really important. This is really important. It's something for your notes. The body of the order block is smart money, right? The body of the order block is smart money that has billions and billions of dollars. The wicks, let me just see this. The wicks, see how it like pokes up and down, up and down. That's retail, randomly buying and selling for no reason. The body, though, that is smart money. So there's essentially two things you can do with an order block. You can, if you really wanted to, you can enter on the body of the order block. Now, I personally don't do this. I just, I enter the whole order block, unless it's got really huge wick, right? Maybe if it was a candle like this, and maybe not, but I just enter at the order block like this, right? Like that. And I put my stop loss. And this is so important, right? Your stop loss always has to be at the liquidity sweep high, right? Right, it always has to be at this liquidity sweep high. I see so many people, they'll get everything right, but they'll put their stop loss here, right, at the high of the body of the order block, right? I know you get away with it this time, but I'm telling you, more often than not, what's going to happen is you're going to get everything right, price going to come up, it's going to poke out your stop loss and then quickly go in the other direction. And that's going to be so frustrating. So please, don't do that. Always have your stop loss at the liquidity sweep high, because that right there is the safest and best place for your stop loss. Now, for take profit, you literally can target a 2-to-1 or 3-to-1, right? For me, I always target a 3 risk to reward ratio like that. Nice and easy. And yeah, that's literally all you need for a high probability order block. Liquidity sweep, fair value gap, entry. That easy, that simple. And don't try and finesse your entry. I always say this, don't try and finesse your entry. If you really wanted to, you could target liquidity here. So if you really wanted to, this could be your long-term target, 4.3 R. But you know what? You don't need that. You need a 2 or 3 risk to reward ratio and consistency. Now, that was a bearish example. Now, let me go give you a bullish example. Okay, so here we are on the next example. Now, can you guys see where the liquidity sweep is? Right, just think for a few seconds. Where is the liquidity sweep? Where is the fake move designed to take out stop loss orders before price moves in the opposite direction? Right? And, I hope it's, or with experience, it will get clear. This right here is our liquidity sweep, right? Price comes down, it wicks down just to take out stop loss orders here, right? Only reason price comes down is to take out these stop loss orders here. It moves up aggressively, it leaves a fair value gap, and it retraces to the order block, and then we want to ride price up. That right there, easiest entry there, pattern possible. You will also notice you can get an optimal trade entry too, but we're not talking about that. This video is purely for order blocks. I know a lot of you love order blocks, and I love order blocks too, bro. I love trading too, but let me mark this out for you. This is our liquidity sweep. We always wait for liquidity sweep. Doesn't matter what entry pattern you're using, optimal trade entry, fair value gap, VWAP, you need to wait for liquidity sweep, because if you don't wait for liquidity sweep, you're going to get swept. And what I mean by that, for those who get confused, is let's say you're bullish on the higher time frames, because most people understand liquidity on the higher time frames. They can get the daily bias right. They know, overall in the S&P we're bullish. But what happens is, they try and buy any sort of retracement here because there's a fair value gap, order block, VWAP, indicator. And what happens is price comes down, it takes out their stop loss and instantly goes to take profit. And this isn't just theory. This used to happen to me all the time. Like, I literally blew my top sub account on the way to work, on the train, and I was so fucking angry at myself. Because this used to happen all the time. Every single time price would hit my stop loss, just like it does with this wick, right? My stop loss would be somewhere here, it would tap my stop, and price would come down. It would literally take out my stop loss and then quickly move straight to my take profit. And it's the most annoying and frustrating thing in the world. It took me years of trading failure to understand that. And those who are asking, ICT didn't, like, I learned from ICT. ICT did not teach me liquidity sweep, right? At least not properly, because he doesn't mention it too much. I learned that on my own, right? You had lots of trial and error to always wait for liquidity sweep. So I'm trying to say to you guys, literally years of pain, right? Years of pain, because those some dark times. So make sure you always wait for our liquidity sweep, right? Liquidity sweep. This is what we want to wait for. Liquidity sweep. The fake move designed to take our stop loss orders, because this will always happen. Let's just make this a bit smaller, like that, right? So here's our liquidity sweep. Now, number 2, what's the next thing we look for once we've got our liquidity sweep for an order block? What's the second thing I told you to wait for? A fair value gap, right? Because the fair value gap just... But for those who are wondering what, why do we wait for a fair value gap? Essentially showing you that price quickly had to move away, right? You see this? You see all this consolidation here? Let's mark this out. See all this consolidation here, right? This is choppy, low probability price action. You also notice how there's no fair value gaps here, right? That's how you know that price action is quite choppy, the lack of fair value gap. And the price, has the fake move, liquidity, aggressively moves off. Now, aggressively moves off, especially for like a tweet or something. I will just tell you that. That's very vague, right? Most people don't understand that. Now, another way of saying aggressively moves off would mean it leaves fair value gap, right? And then price comes down, it enters the fair value gap and the order block, and then we ride price up. So what we're going to do is let's just clean this up. Right, we've got our fair value gap, and let me just mark it out for you. I know some of you will struggle with it. So here's your fair value gap, right? This is the fair value gap. Now, we don't want to enter on the fair value gap unless you're a fair value gap trader. But for me, I always like order blocks optimal trade entry. What we're going to do is we're going to enter it on the order block like this. Stop loss always at the liquidity sweep low. Always at the low. Now, it is much better to have a wider, safer stop loss and a lower risk to reward ratio and a higher win rate than to have a tiny win rate of 20% and to aim for a 10 risk to reward ratio. I'm telling you that because most people don't have the psychology to lose 10 trades in a row and be like sane about it, right? So always have the highest probability trades, and then or take profit. If you want a quick scalp, let's say you're trading indices, quick scalp 2 to 1, easy. I mean that's what, like 15 minutes, and you can make 3K or whatever your take profit is. And if you're a bit more of a day trader, because this right here is the PM session, and by the way, this works on all markets. People keep asking me this. It works on any financial market that has candlesticks, and that literally that's on trading view. This will work for even the Turkish stock market. For whoever was asking me that, it works on that too. But if you want to aim for 3 risk to reward ratio like that, and right literally the final hour of indices, and there's always like a pump up or a pump down, and because people need to get out of their positions or in and out of their position, and you hit your 3 risk to reward ratio just like that. Nice, easy, high probability sales, consistent sales, which are so good. And if you're struggling with daily bias, if you're struggling about the higher time frame, all that sort of stuff, if you see this entry pattern, where you've got your liquidity sweep, you've got a fair value gap, and price retraces to an order block, safe bet, very safe trade that. Okay, so for this model, what we need is we just need the 15-minute chart, right? That's it. All we need is a 15-minute chart. We don't need daily bias now. Now, daily bias will add to the probability. If you know daily bias, then by all means use daily bias. But I've learned from teaching so many students that there's too many things in trading. You don't need everything and to be profitable. All we need is the 15-minute chart. And all we're going to do is we're going to zoom out and we're just going to look for the trend. Right, that's it. We're just going to look for the trend. And obviously, on this market, it's bearish. And this exact model I'm going to show you works on all assets, right? It works on stocks, indices, crypto, Forex, commodities, gold, Bitcoin. It works on everything. Even those altcoins as well. So all we want to do, we get on the 15-minute chart, we zoom out, and we look for the higher time frame trend, right? We look for the trend, and we just follow the trend, right? We're bearish here. We're just going to look for short, right? That's simple. That's all we're going to do. Now, the second thing we do, right, and this is so important, is we wait for a liquidity sweep. Right, we wait for a liquidity sweep. And this is so important because so many people, they don't understand what a liquidity sweep actually is, right? We're bearish, we zoomed out, we saw the higher time frame trend like this, right? We know the trend is bearish. We just want to follow the trend like this. So we're looking for a bearish liquidity sweep, right? Now, a bearish liquidity sweep would look like this. It would look like this, right? Suppose we've got some high here, right? We know there's going to be lots of stop loss orders here because people are going to go short. Our price comes up, it takes out this high here where stop loss orders would be, and it quickly moves down like that, right? And then we want to enter on a retracement. That right there is the highest probability short entry you'll get in all trading, right? And then you just reverse it when you're bullish and stuff. You've got your stop loss there, price comes up, takes out the stop loss orders, quickly moves in the opposite direction, and then we enter on the retracement, right? That's what we need. And if you get that on the 15-minute chart, that is such a money maker. It's honestly such a money maker. And I don't know if you can see, but right here, we have that exact same thing. So here we've got essentially London's high, right? Textbook, London's high, loss of liquidity at this high, price moves down, and then during New York, price comes up, and takes out this stop loss orders here. So let's mark this out, right? Like this, price comes up, it takes out this high here, London's high, where we know lots of stop loss orders are going to be, and it starts to move down, right? Starts to move down like that, right? So the first thing we look for is our liquidity sweep. Right, so let's mark this out. We look for our liquidity sweep, like this, nice and easy. So we're just going to mark this out. Liquidity sweep, right? And here's the thing. Any entry after a liquidity sweep is so high probability, and it's probably the highest probability you'll get in all of trading, right? Okay, so for the next thing we need to do is we've had our liquidity sweep. We know we're bearish on the higher time frame, or at least on the 15-minute chart, right? Which is all we need for this model. The next thing we do, and the last thing we do, is we just wait for a bearish fair value gap, right? We want a fair value gap that forms in the trend direction, right? That easy, that simple. So right here, right, this is our fair value gap. This is our fair value gap. We've got our liquidity sweep. We've got our fair value gap, like that, right? That right there is the highest probability entry you can get in trading. Liquidity sweep, we've got the trend, and then we've got a fair value gap that forms in the trend direction. Okay, so now that we've got the fair value gap that forms, all we need to do is enter on that fair value gap, right? So all we're going to do is, let's just go here. So we're going to enter on the fair value gap. Now, for our stop loss, this is so important. People are asking me this on X, right, on Twitter. They're asking me, do I put my stop loss here? Do I put it here? Do I put it at the fair value gap high? You always put it at the liquidity sweep high, right? The whole point in us waiting for a liquidity sweep is so we have somewhere safe to put our stop loss orders. Because how many times, right? How many times does this happen when you're bearish, and let's say you put your stop loss right here, right? Thinking it's nice and safe. Price comes up, takes out your stop loss, and then instantly goes to take profit. The reason that happens is because you haven't waited for a liquidity sweep, right? The whole point of a liquidity sweep is supposed to find a safe place where we can put our stop loss orders, right? Where we can put our stop loss and not have to worry about it. And right here, we put our stop loss at this high here. Right, this liquidity sweep high is where we put our stop loss. Right, nice, safe stop loss. And now you don't have to have, and I've learned this after years of trading, you don't need, a really tight stop loss. You really don't need a tight stop loss, right? The only people who have really tight stop losses are those who aren't confident and they have a really low win rate. With this model, you will get a high win rate, and we can get at least a 2 risk to reward ratio, ideally a 3 risk to reward ratio. So right here is your 2 to 1. Right, we're going to aim for a 2 to 1. Now let's just zoom out a bit, like this, right? Ideally, and I always encourage my students to aim for a 3 risk to reward ratio, like that, right? Nice, easy risk to reward ratio, like this, right? Nice, good risk to reward ratio. And all we're going to do, let's just move this up. All we're going to do is just play the price action. So your limit order, remember this is the 15-minute chart. So, and this is why I'm a big believer in 15-minute chart. Because first of all, you can see the trend quite nicely, right? So if you zoom out, you can see the trend quite nicely. All right, we can see that we're bearish. And then the second bit is it's not that fast, right? It's not that fast. So it's very easy to read. Very easy to read. I mean, this is so obvious. I mean, I hope it's so obvious, right? You've got London tie, typical sweep in New York, fair value gap that formed in the direction of the trend. All we're going to do is enter on that trend, right? Enter on that fair value gap. So let's just play price action, zoom out and play price action, see what happens. Bam, down. And then we just let price do its thing. Like this, right? Let it do its thing and then bam. Just like that, right? Pick your take profit. Nice, easy trade. Let's see how long this took, right? You entered at 8:30 and you were done. Not even 10:30, so like 2 hours, right? 2 hours in a trade. Nice, easy, high probability day trading model. You can do the exact same thing in London and the exact same thing in Asia, right? This works on all markets, works on Forex, indices, any market, like literally any financial market, it will work on, right? Because there's 2 reasons. The first is the trend, right? The trend, you can't, like smart money can't hide where price is actually going to go, right? They can't hide where price is actually going to go. So the 15-minute chart will give you the trend, the direction. Number 2, liquidity, right? Liquidity is the lifeblood of the market. The only reason price moves is for liquidity. And we know that the trend is bearish, so price is moving for liquidity on the higher time frame somewhere. And then we've got our liquidity sweep. This ensures we get a high probability entry, right? This makes sure that, price doesn't come, take out our stop loss, and then go to take profit, right? So that gives us the highest probability entry. And then the fair value gap in the trend direction shows us we're on the right side of the market. Shows we're on the right side of the market, and then we just enter on that fair value gap. We always put a stop loss at the liquidity sweep high. And if you're bullish, you put it at the liquidity sweep low. That easy, that simple. The reason this model works is because it's rooted on real logic, right? Not some random indicators, not VWAP, not volume profile. Trust me, I tried all this. This model, after 4 years of trading, after being an ICT chart student, is the easiest model in all of trading, right? So go through your charts. And what I would say, you can get a setup every single day as long as you've got a few currencies that you're looking at, right? So if you look through all the majors, or let's say you traded let's say S&P, Dow, and NASDAQ, you will get a sale every single day using this model. And enjoy this model because it's such a money maker. Okay, so for London session, what you want to do is you want to look between 2 a.m. Eastern all the way up until 5 a.m. Eastern, right? Always in Eastern New York time, always in this time. So 2 a.m. till 5 a.m. is London session. Now, London session will always do this. What it will do is it will accumulate around 2 a.m. It will consolidate a bit, gather stop loss orders. Then a fake move will happen, right? A fake move will happen, a liquidity sweep designed just to take out liquidity, designed just to take out lows. Then price will move in the real direction, give you lots of fair value gaps like this. Then it will retrace and then continue on, right? This is what London does consistently, day in, day out, right? So let me just do that again to make it super clear. So around 2 a.m. Eastern, so let me just mark it out around here, price will start to consolidate like this, right? It will start to consolidate. The reason it does that is just to accumulate orders, right? Just to get people buying and selling, just to generate or engineer liquidity. Then what price will do is it will come down and it will take out all these lows here where liquidity was generated. It'll move off in the real direction. It will retrace down here. And then we want to enter on a fair value gap or even an order block, some sort of entry here. And then we want to ride price up, right? That is what London will do day in, day out. And if you don't believe me, go look at your charts. Go look at your charts. 9 times out of 10, you will see this. Accumulation, manipulation, distribution, whatever you want to call it. This is what happens, right? So to trade London session, what you're going to do is just honestly ignore like any price action before 2 a.m. I know, it's going to be, you're going to miss some entries, but just ignore it. Like your time is much better off spent just looking at price action from 2 a.m. onwards and then wait for liquidity sweep on the 1 minute or 5 minute chart. You can do it on the 15-minute chart, but if you do use the 15-minute chart, you're going to get a lot less entry. But here we go. So run the 1 minute chart on gold and you can do this on any pair. And obviously GBP USD, Euro USD, and gold are probably going to be the best of London. And even Swiss franc too. But what you're going to do, wait for the liquidity sweep like we have here. Wait for price to quickly and aggressively move in the opposite direction. Wait for fair value gaps to form, because the fair value gap, right after the liquidity sweep, that tells us where price is actually going to go, right? That tells us that we have a liquidity sweep. Right here, I'm not buying price down here because I have no idea where price is going to go. It could, price could continue going all the way down here, right? But because price shoots off massively and aggressively, leaves fair value gaps, that tells me I'm on the right side of the market, right? That tells me that's just a fake move. Now, you'll see there's a fair value gap here. Let me just mark this out. There's a fair value gap here, but it's essentially filled already. Now, what I mean by that is, you see how the wicks come down, it's filled it, and it's instantly shot off massively, right? Very unlikely, especially if we're bullish, that price, after doing the liquidity sweep, is going to come all the way down here and give us like an insane risk to reward ratio, right? Very, very unlikely, because the real entry was here. Now, if you got the entry, by fair play and stuff, but the real easiest entry, I would say, that we should all look for is this right here, right? Just take the easy fair value gap that forms here. So let me mark this out for you. Right here, the fair value gap that forms. And just look at this, right? You see this little gap here? Let me just zoom out to make this so clear. Look at like how obvious that is, right? Price just taps down just to take out these stop loss orders here, and it massively and aggressively moves on. Massive, big fair value gaps. That's telling us where smart money actually wants to move the market. Once we've got that, we're just looking for our entries, right? We're looking for our entries. And this is what I do. I was trading London for years and years. I'm in the UK, right? And this is what happens consistently. Now, for stop loss, it's so important. So important. Do not put your stop loss at the fair value gap here, right? Or, at this level here. And I know, this in this instance, you get away with it. But the whole point of London is you want to put your stop loss at the liquidity sweep, low or high, right? If it's bearish, you just flip on its head, right? But you always want to put your stop loss at the liquidity sweep low. I always say this, I'm going to keep saying it till everyone's fucking profitable. It's very unlikely price to come all the way up, come all the way down, take out this low again, which was just a liquidity sweep. Very, very unlikely price is going to do that. Take out this low and then go all the way up like that. Very, very unlikely, right? Now, it can happen. I've seen it happen before. But, very, very unlikely that to happen. That's why we always put our stop loss at this liquidity sweep low. Very safe stop loss here. And then for take profit, personally, I always target through risk to reward ratio, even when I was day trading and scalping. And just because I like it, right? It's a nice, easy risk to reward ratio. You can take a 2-to-1 if you want, right? Nice and easy, but especially if you're on the 1 minute chart, you can get some insane risk to reward ratios. But that is literally how you trade London. Let me just show you again, right? Wait around 2 a.m. Expect to see some sort of accumulation. You might see this before 2 a.m., right? But some sort of accumulation like this. Expect price to do a fake move just to come out and take out some sort of stop loss orders, move off in the real direction, leave lots of fair value gaps, right? Leave lots of fair value gaps here, then enter on one of those fair value gaps. Put your stop loss there, and then ride price up, right? that is how you trade London session. And yeah, let me show you how to trade New York session now. Okay, so we're in New York, and New York is 7 a.m. Eastern all the way up until 10 a.m. Eastern. Now, in my experience, after years of trading, this is probably the easiest session because you don't need daily bias. And you don't need daily bias. The bias for New York is almost 9 times out of 10, it's the same bias as London, right? So if you just zoom out, London, it's obviously bullish, right? So for New York, all we're looking for is a continuation. Now, this is what New York will always do, right? This is what it'll always do. So let's suppose this is London, right? London's moved up like this, it's bullish. Price will come down, it'll take out some sort of low. It doesn't have to be London's low, but it'll take out some sort of low, and it'll move off in the opposite direction. It will leave some sort of fair value gaps here, some sort of bullish fair value gap. We can enter on any of these entries and then ride price up, right? Notice how we don't have to wait for a market structure shift, right? And I'm a big believer in just ignoring market structure and focusing on liquidity. Now, a market structure shift would be if this, like, let's say this candlestick, the body closed above this high. That would be a bullish market structure shift. You can wait for that if you want, but you're going to miss so many good entries. So many good entries that, yeah, I'm telling you, if you just ditch market structure and focus on liquidity, your win rate will go up massively. But anyway, here we are on New York, right? So New York, any entry between 7 a.m. till 10 a.m. Is great. Even 11 a.m. really, 10 till 11 a.m. But at 7 till 10 a.m. is when you need to get the golden, I guess, meat of the move. Now, something you need to know, and you must know this for New York, is at 8:30 a.m. Eastern, there's almost always a news announcement. Now, sometimes the news announcements are insane, like CPI, which you avoid, because what you'll see, and you probably see this in your charts, right, is you just have like loads of little candlesticks like this, and then you'll see some massive candlestick where in like one candlestick it does that. That makes sense. And then it goes back to being normal. What that is, that's like a CPI where it's like a news event. And avoid those sort of things. But right here, we've got, I don't know what news it is. It really does not matter, by the way. Right? The news, like announcement, whatever it is, I do not care about it all. All we want to see is the price action, because the price action will tell you everything. So right here, and I hope this is really obvious, right, with this massive weight, this is just a liquidity issue, right? This is a fake move designed just to take out stop loss orders. The only reason price did that, right? I mean, just look at this way. Look how obvious this is. Price wicks down, quickly and aggressively moves off, right? I mean, if you really think about it, quickly and aggressively moves off. And then we want to enter on any sort of retracement, ride price up, right? The same old thing that we always see. Liquidity sweep, massive movement in the opposite direction, and then enter on any sort of entry. Now, this is really important, right? Because right here, we've got, the safest stop loss is going to be around here, right? It's going to be around here. Now, that's a massive stop loss, especially if you're entering on a fair value gap. And you don't have to enter on a fair value gap. This is really important. You don't have to enter on a fair value gap. It's just for new traders, it's really easy to spot. And for me personally, for those who know how I trade, I take like an optimal trade entry. And when I was day trading, right? So I would literally enter at the 0.705 level, like this, right? Like that. Stop loss at the low. And then usually I target a free risk to reward ratio. Like that, right? That's my entry, right? Obviously, I need the liquidity sweep first, right? I don't have the liquidity sweep, I'm not trading. But once I got the liquidity sweep, I will take just an optimal trade entry, a Fibonacci retracing. Because I'm confident in the bias. I've seen this so many times. I know this works. But, you don't need a fair value gap. Because right here, if you've got a fair value gap, you're going to have to put your stop loss here. Let me just show you what I mean, right? You enter here, you have to put your stop loss all the way down here, which is the massive stop loss. What you can do is you can enter on this order block here, right? And I've got a video on order blocks, lots of order block videos. Now, this is quite interesting. There's an order block here, here, and here. So it might be confusing to you about which order block to do. Is it this one? Is it this one? Is it this one? For me, personally, I like how these two red candles are almost together, like that, right? So let me just mark this out. This, for me, would be my order block, like this whole thing here. And just look at the bodies, man. Look how the bodies almost perfectly respect this. They wick into it and instantly shoot off. That right there, for those who are asking, that right there is respect of an order block. Price taps the order block, quickly and aggressively moves off in the opposite direction. That's when, when people say price has respected the order block, it's respected the fair value gap. That's what that means, right? It's tapped it and it's instantly moved off. So right here, I would enter, let's just say if I didn't want to enter the fair value gap, I would enter on this order block here, like this, right? Like that. Now my stop loss would have to be at liquidity sweep low. Yeah, right. Let me just mark this out right here. Has to be at this liquidity sweep low. Now you might be asking, like, what low did it sweep? Like, there's so many lows here that it's just trailed up, trailed up stop losses from. We zoom out, right? So many people are just trailing up their stop losses all the way up here. So any sort of lows that are taken, and that's our liquidity sweep. Now you don't have to be that, rigid and with your liquidity sweep. It doesn't have to be, it has to be a perfect swing low. Which low does it have to take out? You just have to look at price action, right? Just look at price action. If you get on the charts, let's say at this point here, and you've seen this massive wick that's only come down to take out stop loss orders, it quickly and aggressively moves off in the opposite direction. And if you zoom out and you know that New York is almost always a continuation of London, right? And London's been massively bullish, it's a safe bet, right? It's a safe bet that any sort of retracement will do. So what you're going to do is, let's say you want to enter on the order block, stop loss at the liquidity sweep low always, and then you're going to target at least a 2-to-1, or what I always do is target a free risk reward ratio, like that, right? Like that. And remember, we're on the 1 minute chart here, so what time is this? It's about 9:37, and then when do we get take profit? So it's literally about 30 minutes in a trade. And if you're risking 1% on a 100k account like I do, that's like 3k per trade, per funded account. It's a lot of money, boy. A lot of money for half an hour. Yeah, that's my old monthly salary made in half an hour. So, and you can do this exact same thing on the 5-minute chart too, right? So, you know, price is fractal, and what that means is literally forget the time frame, just blur that out. This will be the exact same thing, even on the daily chart. It's the exact same thing over and over again. Price is the same thing. And yeah, so New York, almost always, 9 times out of 10, is a continuation of London. All we want to see is, we want to see, let's say, London's bullish. We want to see a massive bullish movement on London. And then we want to see some sort of liquidity sweep, right? So it doesn't have to be London's low. It can be if you want to wait for it. But any sort of low will do, right? Any sort of, you know, fake move, any sort of large wick that takes out stop loss orders. That's what we want to see. And then we want to see price massively move off in the opposite direction, leave fair value gaps, and then we want to enter on, let's say, a fair value gap, order block, an optimal trade entry, but we want to put our stop loss at the liquidity sweep low, right? A safe stop loss, and then we want to ride price up for a 3 risk reward ratio usually, or a 2 risk reward ratio. And yeah, you guys get the point, right? So for the last session, last but not least, I'm gonna show you how to trade Asia session, and I'm gonna do it all in gold because I like this pair and you guys like it too. So let's get to Asia session. Okay, so for the last session, we have Asia, which is 8 p.m. Eastern time, all the way until midnight, right? So you've got 4 hours for Asia. Now, Asia almost always does this. If we just zoom out, here's our liquidity sweep. What Asia tends to do is, let's suppose we're bullish on the higher time frames, right? So let's say this was London's move, like this. Let's say this was New York's move, where it's, let's say, retraced. It's taken out London's low, and it's gone off like that, right? So it's continued London's trend. What Asia tends to do is it tends to be a retracement on the higher time frame. So if you're bullish overall, like we are here, what you can expect Asia to do is have a little bearish retracement, right? Maybe something like that, right? And then for London, what London can do is London can continue, New York can sweep it, and then continue on, right? So on the higher time frames, Asia tends to be a little bit of a retracement because it's out of all the 3 sessions, London, New York, and Asia. Asia is always the quietest. And just the way it is. So Asia tends to be a little bit of a retracement on the higher time frame. But what that means is, let me just remove this. What that means is, let's say you've been bullish overall in London, New York, you can expect a bit of a retracement going, let's say, in Asia, right? And then for London, it will continue the trend overall. But what that means for us is we're going to look for our liquidity sweep. Now, if you just zoom out, and on the 5-minute chart, this will be a lot more obvious, but like I've just taught you guys on the 1-minute chart because it's just easier, isn't it? So here we go. And here's your liquidity sweep, right? Here's our liquidity sweep. And you can just tell, right? I mean, you can always tell by looking at price action when you get these little wicks like that, right? See these wicks? You see how price just wicks up, takes out stop loss order, moves down, retracement up, and then like that, right? That's what we want to see. So what we have, if we have our liquidity sweep like this, what we want to wait for, let's make this a lot, what we want to wait for is our fair value gap, right? We want to wait for our fair value gap support. Now, this is really important. This is really important. Let me make this even more bigger, right? So right here is our fair value gap, right? This is our fair value gap, like this. Now, price has filled part of the fair value gap, right? It's filled part of the fair value gap like that. That means that this right here is the remaining fair value gap. I won't fill that in properly. This right here is the remaining fair value gap, right? That's our remaining fair value gap that we can enter. Now, for loads of you who are very eagle-eyed, you might, and I don't want to talk about this, guy, I almost never talk about this. You guys might recognize this is an inversion fair value gap, right? This right here is an inversion fair value gap, which is a fair value gap that's been disrespected, and then it almost acts as the opposite direction. So this would have been a bullish fair value gap where price would have tapped it and moved off like that, right? That's what a bullish fair value gap would have done. But because price has broken the fair value gap, right? This fair value gap almost becomes, this bullish one almost becomes a bearish one like that, right? Now, I don't want to talk about that because I've almost never talked about inversion fair value gap, just because I want to keep it very simple. If you could spot that, congratulations, you know a lot about trading. But that's why we have this, I guess, almost partial fill of the fair value gap. It's because there's an inversion fair value gap there. All you guys need to know, all you really do need to know, is that, let me just remove this. What you do need to know is that there's a decent amount of this fair value gap still left, right? So it's very likely our price is going to come and then fill it up, right? if you have, and this is what some people get confused about. If you have, like, let's say this was our little fair value gap, right? Let's say price had wicked all the way up here and there's a tiny little gap. Ignore it, right? Ignore it. Price isn't going to do that. But because the fair value gap's still fairly big, because it's still fairly wide, we want to enter on that fair value gap. Like that, right? So that's what we're going to do for our entry. If you guys really wanted to, you wanted to forget fair value gap, and you could just take the order block, which would be the last up close candle before the down move. But for our entry, in this case, I'm just going to give you the fair value gap. And I hope it's really obvious that the entry pattern is the least important thing. Right, I hope that's very obvious. The entry pattern is the least important thing. Once you've got the liquidity and once you've got the logic of each session, and even an indicator will do. As you know, as long as you've got the liquidity suite, even an indicator will do. So what you're gonna do is zoom out there. What you're gonna do is you're gonna put your stop loss at the liquidity sweep high. You just zoom out. This is the liquidity sweep high. You put our stop loss there. We're gonna target, let's say a minimum 2 risk to reward ratio or a 3 risk to reward ratio. Now, you can, especially if you're in the 1 minute, you can target, a high risk to reward ratio. But I just honestly, if you can get a 3 risk to reward ratio at 50% of the time, you can become a millionaire. You can actually become a millionaire. So, and pass any prop firm and make all the money in the world. So make 10k, 100k a month, whatever you want to make. So you don't need an insane win rate or an insane risk to reward ratio. You just need consistency, consistent bread and butter setup. But yeah, and let me just give you guys more examples, right? So because I know this fair value gap might confuse a lot of you. And don't be confused by the entry. I don't want you guys to understand everything in this video and then be like, oh, what's an inversion fair value gap? Because you really don't need to know it. I'm always in two minds about keeping it in the video just because, but I know some of you understand what that is. For me, personally, this is my entry after years of trading, of being like an ICT chart student. What I would do, and like I said before, Fibonacci, let me just make this clear. Licks the optimal trade entry, which is a Fibonacci retracement, the easiest entry pattern in all of trading, right? Like that. No guesswork. I don't have to guess what fair value gap am I taking. Hey, the fair value gap partially filled, and this order box got a doji candle. Should I put my entry on the body or the wicks? None of that, right? Every single time it's the exact same thing. Stop loss always at liquidity sweep high or low, and then my take profit always a 3 risk to reward ratio, like that, right? Well, you guys, there you go. Right, nice and easy. Set up my limit orders. Once I get tagged in, I'm more of a one and done sort of guy. I let you close the charts and move on with my life. I let price do its thing, right? More often than not, you'll be right. And if you're making 3 times your money, let's say you're working 1k, you're making 3k per trade, you'll make a stupid amount of money. You'll make a stupid amount of money. But that's my entry pattern. And let's say you don't want the fair value gap and you don't like the optimal trade entry, what you can do. And this, actually, let me explain this because so many people I say so many people, a few people were asking me, hey, for the optimal trade entry, what high or low do I look for? You want to look at the most obvious highs and lows in price. Right? What's the most obvious, clear highs and lows? So I'll just go through the charts right now because I don't really want to make a separate video on it because it's a bit of a niche topic. So right here is an obvious low, right? Let me just mark it out. This is an obvious low. This is an obvious high. See this high here, right? Obvious low, obvious high. Obvious low, obvious high. Obvious low, obvious high. Obvious low, obvious high, right? Obvious low, obvious high, obvious low. And then this right here would be maybe sort of an, iffy, maybe obvious high. I wouldn't really consider this a low. This is a very obvious high like that, right? So that's what I would do. Now, let me just make this clear. Some people might think that, oh, is this a high? Is this a low? Is this got liquidity? Honestly, if you just focus on the major highs and major lows, and when you're in doubt, let's say you're in doubt, let me just clear this off. You're like, oh, is this low? What about this or this here? If you're in doubt, just focus on the most obvious ones, the most obvious lows, the most obvious highs, right? Make it clear, make it obvious. If you're in doubt, do not trade it. Just ignore it. So I hope that helps, because I know a few people were messaging me about, hey, I'm struggling about what high and what low to put on. So for the optimal trade entry, you wouldn't put it on this high here, right? You'd put it on this obvious low and this obvious high, right? If you wanted this to be your optimal trade entry, which you shouldn't have, because you should have entered on the liquidity sheet, but your optimal trade entry will be at this high and at this low. It wouldn't be at this high and it'd be at this high and this low, right? I hope that makes sense. Okay, so for the last bit of this video, right, because I know some of you will get confused with the fair value gap, some of you will get confused with optimal trade entry. The last entry pattern, which I would always recommend, is just take the order block, right? Now, the order block is the last up close candle before the down move when you're bearish. So there's videos on the channel about order blocks, so don't worry about that. What you're going to do, enter on the order block, put your stop loss at the liquidity sweep high, like that, right? Like that. And then, right here, right, you're going to target, minimum 3 risk to reward ratio, in my opinion. You can target this low, right? Literally equal lows here. You could do that. And like I said, I wouldn't target an insane risk to reward ratio like that, right? Especially not these lows. You don't need an 8 to 1. You really don't need an 8 risk to reward ratio to be a profitable trader. And all you really need is a free risk reward ratio. But that right there could be your entry, right? If you don't like fair value gap, you're confused about what fair value gap to take, if you don't know what high or what low to put Fibonacci on, just take the order one. The last up close candle, pull it down move. And those 3 entry patterns are the 3 easiest entry patterns in all of trading. Optimal trade entry, which is a Fibonacci retracement, fair value gap, and order one. Now, each and every single one of them will make you money as long as you wait for a liquidity sweep and you get the direction of the market right. But if you listen to this video and you understand each session, you can make money. Now, what I would say on years of trading is just pick one session and master it. Right? For me, it was London. You might be New York, could be Asia, whatever session it is. Pick one and master it, right? Master it, understand it, know how it moves. You can have, 2 or 3 pairs. So let's say for gold in Asia, because Asia is fairly quiet, I would trade gold and let's say GBP, JPY, and maybe dollar yen or AUD, USD. Right? One of those pairs be quite good, right? And you'll see this entry pattern at least in one currency every single day, right? So there'll be a currency that will have this entry pattern every single day in Asia, in New York, in London. All you got to do is find it. That's all you need to do as a trader. Okay, so what am I even talking about? I'm talking about this. This right here is the most important thing I've ever learned in my whole life. But I've already given this, I've taught students this on Twitter, right? On X, on here, right? I'm a legit guy. I've taught them on it and instantly they're profitable. Within like 2-3 weeks, they're showing me payouts. So make sure you pay attention, right? This right here, this image is an image of your mind, right? And I'm thinking, okay, where am I going with this? Just pay attention. This is an image of your mind. Now, most people think that their mind is just their conscious mind, right? But your mind is divided into 2 parts. There's the conscious mind, which everybody knows about. This is where all your knowledge is, all the YouTube videos you watch, all the books, all your knowledge of liquidity, technical analysis, all of that, all your studying, those years of studying, all of that is lodged within the conscious mind. But there's a second part of your mind, which is the subconscious mind. Now, this is so important. This is so important here. Your subconscious mind has all the emotions, right? The subconscious mind is the emotional part of your mind, right? The conscious mind has all the knowledge, all the logic, all the thinking is done by the conscious mind, but all the subconscious mind has all your emotions. This is where your fear is. This is where your greed is, discipline, lack of patience. All of that is within the subconscious mind, right? Now, where am I going with this? Here are your results. You have your conscious mind and your subconscious mind. Now, your mind will control your actions. Your mind will dictate your actions. Whatever action you take, so many people are like, oh, I should have got into trade. I know better. I know, right, here we go. I know in my conscious mind better, but their subconscious mind will force them to do this. And right here, we have the result, right? This is what we actually care about. This is all theory, but this is what we care about, the results, right? It's all we care about. This is your results, your P&L, below account, all of that is your result. That's what we care about. That's what we want to change. Now, you might think, okay, that kind of makes sense. The mind is divided into 2 parts. Conscious mind, which has all my knowledge in, and then the subconscious mind, which has like my emotions in. Okay, how is that going to change my life? Like, how does that even matter? This is why it matters. And this is so, so important. 95% of your results come from your subconscious mind. They come from the subconscious mind. They come from here. This is so important. It comes from your emotional part of your mind, not the knowledge, not your, all the ICT videos you watch, or my videos you watch, or the books you've read, or your technical analysis. It doesn't come from that. 95% of your results come from the subconscious mind. It comes from your emotional part of your mind. This is why you have traders who have said, oh, I've not, it's 5 years of studying, 5 years of being a trader, and I've not made any money. Well, it's going to be 50 years of unprofitability until they hit their subconscious mind. Your subconscious mind will dictate your results in life, in trading, in everything, right? Your subconscious mind holds the keys to success, and it's causing you to fail. This is what caused me to fail for years. It was 4 years where I made any money online, all because of this. All because my subconscious mind was holding me back, right? So it's so, so important that we understand it. 95% of your results come from the subconscious mind. It all comes from here, right? Now, knowledge is important, obviously, right? If you have no idea about trading, you stop 5% that the conscious mind contributes. You're not going to make money from. But most people, I'm assuming if you're watching this video, right, about trading psychology, you understand trading, right? I mean, even in 3 months, you become profitable, right? As long as you've got like support and resistance will work, it'll give you a tiny win rate. And over a long run, you can still make money with it. You make money with doing anything, right? Even a coin flip, they've been improving that. But what happens is with all traders is that our subconscious mind holds us back, right? It holds us back, and this is where all our theories, their greed is, the discipline, all of that is lodged within the subconscious mind. If I asked you logically, hey, do you want to be a guy who lacks discipline, can't follow his model? You're like, no, of course not. Your conscious mind will say, yeah, no, of course I don't want to be that. Your subconscious mind's like, yeah, we do. Yeah, that's what we're going to be. Now, why? Now, this is really important. Why is that? Like, why do we have fear? Because for me, I was afraid to lose. I was very very disciplined. I didn't have any greed. I was very patient, but I was afraid to lose. I was afraid to lose. So I've seen myself, and I'd be too scared to pull the trigger. And what that meant is I'd miss so many profitable trades, and I'll take, losing trades, and I'd be scared. I'd blow accounts. I blew my Top Step account. I don't know for those who don't know, I blew my Top Step account. I was like, oh, for fuck's sake, bro. Like, that meant so much to me as well. So I was dead scared as well. I was scared to lose any prop firm challenge. And when you're scared to make money, you don't make money. So scared money repels money. Okay, so now we're getting into the meat of the video. This is absolutely gold dust. And, if you watch this far, so many people will just click off in the first minute. But if you watch this far, this is so important. This is what's actually going to change your life. We have something called a self-image, right? Your self-image, let's mark this out. Your self-image here is very deep within your subconscious mind, your childhood, and even, all your life experiences. You would have heard stuff. And this is why most people don't make any money online, is because you would have heard money doesn't grow on trees, money's hard to get, you need I made a money, all that sort of stuff goes into your self-image. And your self-image, in this case, the money, that money's really hard to get, right? When it's not, right? It's actually really easy. It's really easy to get once you know what you're doing. Once you've got this in your mind. But your self-image is so important. Your results are all dictated by how you see yourself subconsciously. Not if me and you were in a room and I was like, hey, what do you think of yourself? Oh, I'm a confident guy. I know how to trade. It's not what you would say to me. It's not what you want other people to, think about you. It's not what you want, right? It's what you deeply believe in your subconscious mind, right? Without even thinking. How do you actually see yourself? Yeah? Because, a lot of you see yourself, and even I was like this. I saw myself, almost a bit of a pussy, right? I was afraid to lose. I was scared, scared to get into trade. I was deep within my subconscious mind. Deep within my subconscious mind also was that money was really hard to make, and it was hard to get, and it was hard to keep. All that sort of stuff held me back for ages, because within my self-image, I had all these negative traits. Now, this video is just about trading, and I wanna literally, and if you watch my videos, I'm all about no BS, practical solutions. Let's fix the problem. But I need to tell you guys what's holding me back, and then I need the solution, because the solution is very easy, very bizarre, but really easy. So here we go. Your self-image, and this was me for ages. I guarantee you're saying things like this. I want to be a profitable trader. Here we go. Do you know how it's want? Not I am. I want to be a profitable trader. I lack discipline. I'm afraid to lose. Yeah, I used to do this all the time, right? When I'm profitable, I will do this. When I'm profitable, I'm gonna live in Dubai. I'm gonna get into property, like all that sort of stuff. This was me as well. One day when we're rich, like how many times have you and your mates done that? One day when we're rich, we're gonna be here. We're gonna do this. We're gonna do this. Right. When you keep saying this, what you're really saying to your subconscious mind is, I am not that person already. I am not a profitable trader. That's all we care about in this video, because we're talking about trading. All we care about is being a consistently profitable trader who makes money. That's all we care about in this video, right? I might give you a few gold nuggets about money and maybe even women later on, but this video is purely about trading, right? For the most part. So here we go. All we care about is being a profitable trader. Now, your subconscious mind has no ability to think. It cannot think for itself. Your conscious mind does all the thinking for you. Right? That's where all your knowledge is. It's just all the thinking for you. The subconscious mind just accepts whatever goes into it. It accepts, and it turns into result. It manifests into result. Right? Key word there. It manifests into result. That's what manifestation really is. And most people have no idea what they're talking about with manifestation. Here we go. Right? When you say things like, I want to be a profitable trader, I lack discipline, I'm afraid to lose, and when I'm profitable, not I am profitable, when I'm profitable, one day, all you're always telling your subconscious mind is, I am not a profitable trader. I'm not a profitable trader at all. Now, your subconscious mind cannot think. So it thinks, oh, well, Atif, right? Me, oh, he doesn't want to be a profitable trader. So what he wants is he wants me to be, he wants me to keep him as an unprofitable trader, right? For some reason, he likes studying, right? Yeah, that's what, whenever my mates would ask me, and you probably have this too, oh, what are you trying to, what are you doing? What are you doing? Oh, I want to be a profitable trader. I want to be a trader. I want to be a trader. Your subconscious mind is going to keep you as a guy who wants to be a trader, right? This is so, if you can really understand this, you can easily change it. Your subconscious mind is going to keep you as someone who wants to be a trader, right? Oh, this is his identity. Because that was my whole life for years, that I'm a guy trying to learn how to trade. Well, if you're a guy who's trying to learn how to trade, you're going to be forever a guy trying to learn how to trade. Because your self-image and your subconscious mind is going to see that. It's going to see that you get really emotionally involved, right? That you're really passionate about it. That, oh, this guy, for whatever reason, he really wants to be a guy who learns how to trade. He wants to be a guy who wants to be a profitable trader. He doesn't actually want to be a profitable trader. Your subconscious mind is going to think, oh, he enjoys watching YouTube videos. He enjoys reading books. He enjoys, learning about liquidity and all that. It might be interesting, but at the end of the day, we want the result. We want the P&L. We don't want blown account, right? But the only way we can do that is to not identify with any of this crap. Like, I get so many people saying to me, I'm afraid to lose. Now, when you say I'm afraid to lose, your subconscious mind thinks, oh, I want to lose. Right? I want to lose. Let me keep making this guy lose, right? Let me keep making this guy lose. Here we go. I lack discipline. Let me this up. I've got 18,000 followers. I get hundreds of DMs from traders every single day. And I get this sort of stuff all the time, right? Where I say, I'm afraid to lose. I lack discipline. How many people say this? Oh, I'm good at trading. I just lack discipline. But when you say that, it goes straight into the subconscious mind. Straight into the subconscious mind. And your subconscious mind will dictate 95% of your results. So when you have that in your subconscious mind, that you lack discipline and that you're afraid to lose, that one day you'll become a profitable trader. And when you keep saying stuff like that, when you say one day I'll become a profitable trader, well, that one day is never going to come. Because your subconscious mind is going to keep you as a guy who's waiting for that day to come. Right? It's very stupid, your subconscious mind. It has no ability to think for itself. Okay, so it's all well and good me telling you this, right? It's all well and good me telling you this, that your self-image is going to hold you back. But I'm all about solutions, right? I'm all about solutions. Now, your subconscious mind, like we said, has no ability to think for itself. So when you say stuff like this, I want to be a profitable trader, I like this, I'm afraid to lose, it will make it happen. But we can also lie to ourselves, right? In a good way. We can say to that, I am a profitable trader. If we keep saying that and we keep believing it, that will come true. So I'm going to show you how we can turn or essentially flip the scale into our side, right? How we can put the odds in our favor. And yeah, once we understand this, literally anything you want in life will happen. Well, let me just clean these charts up and I'll show you what I'm talking about. Okay, so I'm now going to give you the solution, right? And we know the problem, we know what's holding you back. And if you guys have watched this far, you guys deserve this. So here we go. Right. We need to change your self-image into something that's positive, right? And in this case, what we're talking about, and this applies to anything in life, right? So money, women, like whatever you want, cars, house, whatever you want. We have to change the self-image. Now, in this case, we want to be a profitable trader, right? That's the goal. We want to be a profitable trader. We want to fix our psychology. Now, we want our self-image. We don't want to even identify with any of this, right? We don't want to identify with fear, greed, discipline, patience. We don't want any of that, right? We just want to be a profitable trader. And this is why I know every single person watching this video, they identify that they've got an issue in their trading psychology, right? So it's pretty deep within their subconscious mind. So what we need to do is we need to change your self-image. Right? We need to change how you see yourself on a subconscious level. Now, the only way we can do this is by repetition, over and over and over and over again, right? That's the only way your subconscious mind learns. And it usually takes about 2 weeks, 2 to 3 weeks before your subconscious mind starts to change its, its belief, right? So what we're going to do is we're going to write an affirmation. Now, an affirmation is something that you literally write on a notepad, right? So you just write it out as many times as possible. Now, I would say you get one A4 notepad, and you just write it out consistently. And the affirmation I'm going to give you is, I am so happy and grateful now that I am a profitable trader. Now, this is so important. And this is the affirmation that I gave out on X. What the heck is this tweet? But yeah, I've given it out on X. I had so many students that DM me saying that, oh my God, I'm finally profitable. Like after like 2 or 3 weeks, like I'm finally profitable. I fixed it. I even had a private student, right, of mine. I think she got a 100K account. She made 20K on that 100K account within a month. A 100K account. That's insane, right? By doing this is exactly what made her profitable. It wasn't a technical analysis. She already knew. She had lots of knowledge of technical analysis. It was this. This is what made it click. When people say trading took me 4 years, then it clicked. What they're really talking about is that in their subconscious mind, they finally changed their self-image. Now, they probably had no idea what they were doing. But, by trial and error, they fixed it. They fixed their subconscious mind, and bam, just like that, 95% of your results, instead of 95% of your results being negative and fear-based, 95% of your results are positive now. Right, they're positive. And you guys, you can literally just watch, my free video on my channel, like the full trading course, right, completely for free. If you watch that, you have all the knowledge you need to become profitable. Right, we have all the knowledge. All we need now, imagine if this was 95% of the results were positive from your subconscious mind. I mean, literally, you have a money printer, and it literally is a money printer. So here we go. Now, I've put I am in capital letters because I want you to emphasize I am. Because when you say I am, I don't want to get too deep or too spiritual into this, but what it does is it essentially opens your mind up, right? Your mind's paying attention. I am is who you really are as a person. It's who your mind is. So when you say I am, I like to just put emphasis on it, not you know what I mean? Like if I said you're so happy and grateful now that you're a profitable trader, it doesn't have anywhere near the impact of I am so happy and grateful now that I am a profitable trader. So this affirmation is so powerful. What you're gonna do is you're gonna keep writing out. Now I don't have an A4 notepad with me. What I do is I get an A4 notepad and I just write it out as many times as I can. I usually do one. I'll be completely honest. I do like one whole page of an A4 notepad, just consistently writing this out, right, over and over again, and then picture yourself. Visualize in your mind where you want to be as a profitable trader. Picture you having that FDMO payout. How much money is it? right? Picture your name being right there. It's got that signature on it, got HTML at the top. Your name, how much money have you made? 10K, $1,000, 5K, how much have you made? Or Top Step account, right? Your name on it, Top Step at the top, and how much money have you made? 5K, 10K, 15K, 20K, 1K, $500. Like, how much money have you made? Right? Visualize that in your mind and then write this out. I'm so happy and grateful that I'm a profitable trader. Now, why does this work? Right? Why does this work? There's two reasons. First is I am, which is interestingly, it's God's name in the Bible, which make of that what you will. But here we go. So, and the second part is I am so happy, right, and grateful. Now, what is happy and grateful? Just think, right? What is happy and grateful? If you were at school, what would people say happy and grateful is? It's an emotion. Oh, you start to see now. It's an emotion. So when you say I am, right, first of all, you're thinking about yourself, and I'm so happy and grateful. What that does is essentially, I know it sounds stupid, but it kind of opens the ears of the subconscious mind, right? It's on alert. Like, oh, this is an emotion, right? If you're happy, that's a positive emotion. And grateful, positive emotion. Your subconscious mind is now alert. Like, oh, is he speaking to me? Right? What does he actually want to say? And you keep saying, I'm so happy and grateful. Now I am a profitable trader, right? And that goes into your self-image. It takes about 2 to 3 weeks of writing this out consistently before it changes your self-image, right? And you know how I said the self-image, the subconscious mind has no ability to think. It cannot think for itself. And, you know, when you're saying, I want to be a profitable trader, it's so stupid that it keeps you as a guy who wants to be a profitable trader, not a guy who actually wants to be, not a guy who already is a profitable trader. But we can also abuse that and use it to our advantage. And this is how we do it. We keep telling our subconscious mind, I'm so happy and grateful now that I'm a profitable trader. It goes into our self-image, goes into the subconscious mind. Our subconscious mind, like, oh, you know, after about 2 to 3 weeks, it's like, oh, okay, well, we are a profitable trader. It will eliminate anything that's not conclusive to it. I don't even know what that word is. Anything that doesn't help it or support it, it eliminates instantly, right? Now, I don't want to get too spiritual into this. There's lots of reasons why. There's something called infinite intelligence. We're not going to get too much into it. It's either infinite intelligence or God, right? Someone makes this happen, right? By law, this happens. All the richest people in the world use this. And this is something you probably heard a lot, and you probably heard it completely misunderstood. This is something called the law of attraction. There you weren't expecting that. What a golden nugget that is. This is really the law of attraction, because what happens is you keep saying this over and over again. It goes into your self-image. It goes into your subconscious mind. Within 2 to 3 weeks, your self-image and your subconscious mind now sees you as a profitable trader, right? For ages, it saw you as a guy who lacked discipline and kept you as a guy who lacked discipline. Now it sees you as a profitable trader after 2 to 3 weeks. What it's going to do, it's going to attract every single thing it needs for you to become a profitable trader. Now, whether that's you winning a giveaway, right? Whether that's you going on a winning streak forever, right? Or well, and this is really important. This is so important because so many students are asking me this. They're saying, hey, look, and you know, I kept writing these affirmations down. Most students were like, oh, you know, I'm profitable within 3 weeks. Some students were messaging me. They were saying, you know, I got on a massive losing streak. And this is what happened to me, right? When I started doing this, I started writing this out. I'm so happy and grateful that I'm a profitable trader. I went on a losing streak, like a 10 losing streak, the worst losing streak I was ever on. Now, the reason why that happened is so important, is it was God or, you know, infinite intelligence or the universe, whatever you want to call it, my subconscious mind, whatever you want to call it, was telling me to look for your trades, look for your losing trades. I looked at them, I was like, 9 times out of 10, literally 9 losing trades out of 10 was when I went against the higher time frame trend, like the daily buy, right? So the market's a bull market overall. I'm shorting, and every time I'm losing, it's like, yeah, obviously you're losing. So you might go on a nasty losing streak, and the whole point of that is God, is with your mind telling you, hey, look, fix this. Go look back for your old trade. Fix what's holding you back. So much holding you back. You might have every time you trade a London session, or here we go. Every time you don't wait for a liquidity streak, you lose, right? That is your mind telling you, hey, stop trading when there's no liquidity streak. Wait for a liquidity streak and then enter. Right? For me, it's every time you go against the high time frame trend, you lose. Right? Your subconscious mind deliberately making you lose those trades. So you look through them and you think, oh, well, every time I go against the higher time frame trend, I'm losing. So let me go with the higher time frame trend. And then I went on my highest win streak. Right? Well, I'm my 15%, bro. That's like 15K per 100K account. So insane, bro. Absolutely insane. And this literally changed my life. You can do, and I mean, we're quite long into the video, right? But you can do this for anything. Now, I know this is about trading psychology and stuff, but you can write, I'm so happy and grateful now that I am whatever you want. Now that I am irresistible to women. Now that money comes to me in increasing quantities from multiple sources on a continuous basis, which is what I do. And anything you want. Or I'm so happy and grateful now that I'm effortlessly earning 10K a month, 100K a month, a million a month, whatever you want. Just remember, there's a time lag. This is what breaks most people, most unsuccessful people anyway. But I'm assuming if you put years into trading, and you can overcome this, right? Most people, they want instant gratification. They'll write this maybe for a day or two, they don't see results, and they quit, and then they go back to the same thing, fear, greed, whatever was holding them back, and they're saying that, almost a cycle of death, right? It's almost a cycle of death where they just endlessly go in the same loop of just failure, frustration. They don't realize it's their subconscious mind that holds them back, right? Your subconscious mind holds the keys to literally heaven, right? Literally heaven. I don't get too deep into it, but that's really what heaven is. It's a great state in your mind. But here we go, right? Summarize this video. What you need to do is you need to change your self-image. Don't identify with any of it. Don't identify with anything that's holding you back. Fear, greed, lack of patience, blown accounts. Don't identify with it. Have nothing to do with it. All you want to do is convince your subconscious mind, I am so happy and grateful now that I'm a profitable trader. That's your only goal. Because in this video, we're talking about trading. Your goal is to convince your subconscious mind and to change your self-image that you are a profitable trader, right? And this will take about 2 to 3 a week. Give it a month, and I guarantee you this will change your life. Now, just be careful. If you're on a losing streak, that's your mind telling you, look back through your trade. There's some pattern in all your losing trades. Eliminate that pattern, right? If you go against, the highest time frame trend, and eliminate those trades. Don't even take those trades. For me, that's what it was. For another guy, I think it was a liquidity sweep, something like that. It was a liquidity sweep. But yeah, someone was messing with that. But this honestly will change your life. It will honestly change your life. There is nothing that's going to fix your trading psychology apart from it. It's the only thing that's going to change your trading psychology. It's changing your subconscious mind. Journaling is not going to help you, but journaling is good. And let's say, if you're a new trader and you don't really understand what's holding you back, journaling can be good. Because me, I didn't know what was holding me back. And so I read my journal, and then I was like, oh, I'm afraid to get into so many trades. I'm just afraid of getting into trades. That's what's holding me back. But it's no point in knowing that, oh, I'm afraid to lose trade. Well, what's that going to do for you? You're going to fix it. Like, you know what's holding you back. What's the solution? Now, I'm always big on the solution. This is the solution. It took me a few months to understand this. And this works. This might sound like woo-woo BS, because when I first heard it, it was insane. But trust me, this actually works. There's one thing you do this. Just write this down. Just feel it, right? Just let yourself imagine. Just feel it. What's it feel like to be a profitable trader? I'm so happy and grateful that I'm a profitable trader. Like, if you watch this, you deserve to be a profitable trader. You put in the months, the years, you put in thousands of hours. You deserve to be a profitable trader, right? This is what's holding you back, your subconscious mind. But your subconscious mind, even though it's your worst enemy, it can be your best friend. Right? And when it's your best friend, you'll live a happy life. So yeah, I have rambled on a lot in this video, but this video is so important. I love this topic. Honestly, changed my life. It will change your life too. Just give it the benefit. Just trust it. Trust the process. Write this out on an A4 notepad every single day, and just feel and act like you're a profitable trader. Never ever say, I'm afraid to lose. Anything negative. Only think positive, and change your subconscious mind to what you want it to be. Okay, guys, this is the end of the course, right? I hope you guys enjoyed it. If you got to this far and you watched the whole video, congratulations. You're in the top 10%, probably top 1% of traders, and you have what it takes to succeed. And if this was your first time, or maybe you're a bit new to trading and you're still unsure, I made a full, completely free trading model, full PDF. You get, examples, everything that you need to become a profitable trader. So make sure you check that out. It'll be in the pinned comment down below. And like all things, practice. Get those reps in. Just like the gym, just like maths when you're at school, you kept doing the problem sheet. Just like programming, got to keep doing it over and over again. You'll eventually figure this out, right? So make sure you go and check out that completely free, full PDF. It'll give you something to work on. It'll give you something that you can look at consistently and work on and build on. But other than that, make sure you guys like and subscribe. This took me so long to make. So you guys like and subscribe. And I'll see you guys next video. Peace.